We're going. We were able to get some breakfast out there, and we appreciate you being here bright and early. I know that starting at 8:15 is early, but we have a great agenda here, and we just are grateful that you're here this morning. Before we launch our presentations, a few things. Up on the screen, you'll see the Wi-Fi password. It is not correct on your agenda, and we apologize for that. And that's why we've tried to have it up on the screen. So right now, if you'll write that down so that you have the Wi-Fi password, and hopefully with all your technology, you can connect into the network. Okay, well, welcome. You know, I hope that you had a good time yesterday. I hope that last night was entertaining and that you enjoyed the wonderful music of Lexi Walker and Kurt Bester, and that was an enjoyable time for you. We did try to come up with a good theme of you know, Clark and I and the team. We sat down and said, what would be a good theme? And you know, it's been a tough 18 months. You know, we've been in the middle of this major pandemic that has basically shut down our whole economy. I never thought in the 20 plus years that I've been in the industry that I'd see the whole economy shut down like we've seen. So we thought, you know, it'd be nice to just get back to being able to be with our clients, have a good time, and provide an educational experience for them in our conferences. We've been doing this for 20 years, and it's great to be here with you. And we appreciate you being here. And this is really the purpose why we bring you together, is that so we can get to know you better, and also that you can gain more knowledge on the investments that are in your portfolio, and learn more about what Soltis is doing, and where we're headed as well. So, you know, it's early morning, so I hope you're awake. We're going to awaken and talk about how we feel like we're ascending and going to new heights. I want to, first of all, we've mentioned our sponsors. We could not do this conference without our sponsors. And we have up on the board our platinum, gold, and our silver and bronze sponsors. Would you all stand up? Many of them are here in the room. Would you stand up, and could you give them a hand? We are grateful. You'll see some very sophisticated companies up here. You're going to have the opportunity to hear from many of them on your agenda. Many of them are in your portfolios. They may not be in your portfolios, and one of the reasons that they're here is for you to know more about them. But we could not put on a conference like this without our sponsors, and we're so grateful that they're here. Well, where have we been? As I mentioned, you know, it's great to be able to be in a conference like this, but we've been in a very difficult global pandemic with the COVID-19. And I just wanted to start with where we've been, what we've done, and where we're going. Obviously, a few pictures here. You know, we've had literal, retail shops and restaurants closed down, haven't we? We've witnessed that. We continue to see, you know, some of that. Airlines, we've seen jets grounded. We've seen cruise lines, you know, at shore. It's kind of amazing the impact that all of this has in the supply chains, and as we are coming out of this environment, to see the economy and some of the places that parts of the economy that have done well, and some of those that have really struggled. Last night, you had entertainers that were entertaining you. They've been hit hard, haven't they? They haven't been able to perform like that. Airlines, you know, we have clients that are airlines, and they've surely been hit hard, as well as the the cruise lines. I'm amazed at the amount of food that you eat on a cruise line, and the farmers have been hit hard, haven't they, because of this shutdown. We've also seen offices that have become empty. and we've had to do business just in a different way. And I'll never forget it last November being in Chicago and looking at the streets, and they were just nobody, on the streets. I remember, during the pandemic coming into Salt Lake City and just seeing cities shut down. So it's been a difficult 18 months. Again, there's been a lot of things that have happened. And today, as we talk about the economic backdrop, we talk about some of these investments. There's been definitely areas that have thrived as well. So what did we learn? We learned a lot of things. Number one, I want to just point out how precious life is. I think all of us, have had maybe somebody that we know that has been impacted by COVID, and just realizing really what matters most, in life, and how precious it is, and how vulnerable it can be with a major, pandemic. We've learned to do business differently. A lot of us maybe hadn't even heard of Zoom or Microsoft Teams or GoToMeetings, but we've continued to be able to function because of technology, and technology is driving a lot of what we do today. We see that even pets like to participate a little bit in our meetings today, and as well as children, right? As we're on these Zoom meetings, you may hear dogs barking or kids wanting to become involved, but we've learned to work from home. And, a lot of our sponsors that are here, I've talked to a few of them that said this is the first event they've been able to come to, and so it's nice to be able to come out of that. But as we go forward and we look at the future, it definitely will be driven by technology. We've learned a lot in the markets. We had a 34% decline in the markets that happened within a couple months. So a huge decline in the markets. We've learned a lot about the importance of staying true to our long-term investment portfolio, to stay calm during these times. Diversification in your portfolio, making sure that you have proper diversification, and some of the best advice that we can give is to make sure that you as clients get a feel for what's happened, what's going to happen, and sometimes the best advice we can give is just to stay the course, with your long-term strategy and your long-term investment goals. We have really missed just being together, though. To be able to be in the office and have be able to sit, face to face with you, our clients. Well, what did we do? There's quite a number of things that were done that I just want to highlight. First of all, as I mentioned, it was good for you to have stayed the course through this downturn, to stay with your investment goals and long-term strategy, to make sure that we stay, true to our investment discipline. Grateful for our investment team. You'll hear from Bill Wallace and Hal Anderson and some of our other investment committee members, and we definitely benefited from staying the course. We did rebalance the portfolios at the trough and at the peak, and there's quite an advantage to rebalancing your portfolios, and it assists them going forward. We recognized in the bottom of this market downturn that there was going to be some great opportunities, some stocks that definitely were discounted and had declined, but gave us great opportunity. We created a recovery portfolio. Some of you participated in that really benefited your portfolios. We took some positions. We've created a new growth portfolio during this time frame. Hal Anderson leading the growth portfolio. We've identified some high quality investments that you're going to be exposed to today. With the tax laws and with capital gains, there's always a need to look at your tax strategy within your portfolio. The introduction of opportunity zones, which came through the Trump administration's tax opportunities, today will highlight a manager that we've used for opportunity zones. We have continued to evolve our investment committee and looking at different asset classes that are lower correlated to the regular market in terms of private investments and private markets, with the creation of a private alternative committee. Today, you're going to be exposed to our research that we've done on digital currency and cryptocurrencies. You're hearing a lot about that I'm sure in the news and in the press. And today, you'll hear more about the research that we've done at Soltis and what we're doing on the digital currency and cryptocurrency. And we've just, really created an environment of, being able to, at Soltis, be able to continue to function, as I mentioned, despite the fact that we haven't been able to come into the office over the last 18 months. We did react and we're able to continue to service you, our clients, and to move to higher grounds. So I just want to take a minute. If you have the chance to ever come into our St. George office, we commissioned an artist to do a painting of the bristlecomb pine tree. And so I want to just talk about that briefly. You'll see it here as you come into our office. It's an amazing tree that lasts through droughts, can survive where other plants can't survive. The oldest species of this tree have lasted over 5,000 years, and they're very resilient, resistant to the invasion of insects and pests. And this painting stands as a sort of reminder to us at Soltis that in our goal to be resilient, durable, and being able to endure and make it through the difficult times. We're 28, almost 29 years since the firm was founded, and we're excited about the future and being able to continue to survive through these difficult times. We were recently recognized by the Retirement Plan Advisors, top 100 advisors, and Financial Planning just came out with their top 150 RIA firms in the country. And we continue to be recognized by Financial Times, Barron's, and some of our local recognition as well. A few weeks ago, we were at Snowbird, and we had the opportunity to have one of the top executives of Fidelity that was with us, that is over all of the registered investment advisory firms in the country, shared some of the statistics. I just wanted you to see that there are 13,494 registered investment advisors like Soltis Investment Advisors in the country. As you can see the breakdown, you'll see that those that manage over $1 billion in assets is the upper 6%. Those that are at 5 billion are in the upper 1% percentile. And today we are responsible for over $6 billion here at Soltis. So we're in that top 1% of those registered investment advisors that are out there that provide advice, important advice to clients. So I wanted to take a minute as we look at our goals to be a future-ready firm, to be a firm that can survive, going forward. There's a lot of things that we're focused on, and I just want to focus on a few of those. First of all, our strategy, some of the long-term business goals that we've had, and look at where we've been, where we're at, and sort of where we're going. This is just kind of a historical. I want to just point out that 28 years ago, the original founders discovered, created the firm to be a firm that is fee only and eliminate the conflict of interest. That's, very core to the whole foundation of the firm. So Hal Anderson, who's here, who's one of our original founders, and Hiram Smith and Lon Henderson, recognizing a business model that now is very prevalent because it's been recognized as the best model for managing assets in a fee-only environment. Early on in 1993, Hal and Lon recognized we needed a very strong custodian. We chose Fidelity to be our custodian, to be our business partner in securing your assets. We use other custodians, but Fidelity was chosen from the onset to be the main custodian for our assets. We entered in 1998, the institutional market. We consult on 401k plans and retirement plans for some of the best companies in the country. We take on a fiduciary role, not only with you, but with those clients as well. I see a lot of advertising now about, is your investment advisor independent? Is your investment advisor a fiduciary? We've been a fiduciary from the very beginning in 1993, and was a key strategic decision that was made by the founding partners of the firm. We've aligned ourselves with great key distribution and relationships. You know, it was back in 2004 that we began these conferences. We've been doing these for 18 years, 19 years, where we've had the opportunity to bring industry experts here to a conference like this and to be able to be with our clients. In 2007, there was a decision to partner with Fiduciary Network. It's Immigrant Bank. They are a capital source for us. They're a business partner to us. There's 20 registered investment advisory firms that are all in that top 6% of those in the country that we network with, and they're a key business partner and strategic decision that Soltis made back in 2007. It also allows us to have a succession plan, and we have a great succession plan in place with new partners that are owning the firm and taking over leadership roles. In 2012, this is an important point to make. We became a CEFIX certified registered investment advisor. There's only a few of us in the country, and this is something that we have spent a lot of money and time in doing. We basically subject ourselves to an audit every year. CEFIX is a third-party entity that comes in and conducts that audit to ensure there's no conflicts of interest. We do not get paid by any of the funds that are in your lineup, and they make sure that we're true to that. They analyze our process for selecting managers, for evaluating funds, reviewing our process. And every year we pay for that, and they come in, and we continue to have that designation as a CEFIX certified financial advisor. In 2015, we opened our Salt Lake City office. St. George here is our headquarters, has been since 1993. We opened our office in 2015 in Salt Lake City. We had the opportunity to bring on two very key people. Brent Moore, where's Brent Moore? Brent's our managing partner. Will you stand up, Brent? Brent is our managing partner in the Salt Lake City office and was with Key Bank. Yeah, let's give Brent Moore a hand. Brent Moore and Bill Wallace, who is our Chief Investment Officer, if you'll stand. These two good men came and joined the firm in 2015 and have a lot of years of experience with Key Bank, and that's been a key strategic move for us. It allowed us to be able to further and broaden our geographical reach in Salt Lake City. We qualified in 2016 for the Fidelity Retirement Referral Program, and some of you are here that have come through that program. There's only a few advisors in the country that qualify, and the only way to qualify is to continue to have investments that are offered outside of Fidelity that are attractive to investors, and that's been a key partnership for us since 2016. We recognized, that we needed to continue to evolve in our investment division, and as was mentioned before, we've expanded to private alternatives, as well as looking for asset classes and managers within your portfolio that can hedge, as well as for risk, as well as provide low correlation to various asset classes. We have expanded our reach since 2019, and we do have offices, and I'll introduce that in just a minute. We have offices in Washington now, in Dallas, Texas, Arizona, and way out in Michigan. And so we have six office satellite sites now, and we've expanded our reach. And then we've expanded our investment innovation by, as I mentioned, Hal Anderson returned to us. As you know, he had a 3-year ecclesiastical leave, and he is back and leading us on the private alternative side. I wanted to just have Hal stand. Hal is a founder of the firm. Hal, will you stand up? And we're just so grateful to have him back. Our mission statement is to support you all in building your wealth and managing it so you can pursue your most important endeavors. And Hal and Julie's here too. Julie, will you stand? I think it's important for you to stand. Julie has come back and returned to the firm, and we're just so grateful for the opportunity to have Hal back in the firm. Well, going forward, as we look at some of our strategic initiatives, we must continue to innovate through technology in our services to you. We must continue to see the industry and identify, the services that will continue to benefit you in what's important to you and in your life. We want to continue to go up what we call the value stack. We manage money, we do financial planning. We are now looking at other services and things that will help you in multi-generation planning and passing down values instead of valuables, and all those many things that are kind of fulfillment things that are important to the client. We'll continue to look at technology and make sure that we're efficient in our scale. And we do intend to continue to bring on great talent through M&A and expanding our market reach. I want to just spend a little bit of time about our talent, and I want you to know while you're here who represents Soltis in the different locations that we're at. We have experienced a lot of growth here in the last couple of years. It started as we look at talent again with these three in a little pioneer home here in St. George, Utah, with Hal, Lon, and Hiram Smith. Hiram Smith passed away about a year or so ago, and we miss him, but continue to benefit from his profound influence. So it began with three in 1993, and we've expanded our St. George office. We have 26 employees now in our St. George office. 2 years ago was the last time that we had a conference like this. We had about 29 employees at that time, managed about $3.7 billion. We're now over 50 employees with over $6 billion in management. So we've seen significant growth. We have 26 employees that are in our St. George office. Our Salt Lake office, I mentioned Brent Moore as being the managing partner there. We have 13 that are in our Salt Lake office. We expanded to Washington. I want Wayne Demeester to stand up. Wayne's over here. Will you stand up, Wayne? Wayne and Bruce Merrill, they're in the Washington area, began a great opportunity for us to expand into that market. We've moved TJ out there now, and we're growing in the Washington, Seattle area. In 2019, a man named Matt Brand approached the firm, and we began to talk to him. Matt is here, as well as Glenn and Jason. Will you three stand? I know you're here somewhere. Where are you? Our Texas. There we are, Texas. We opened an office there in South Lake, Texas, and have seen substantial growth there through Matt's leadership. We're grateful for the clients that are even here today from Texas that have come to this conference and joined us. We expanded into Arizona with a couple that joined our firm from TIAA-CREF. We have Spencer Humphrey and Cody that are in our Arizona office and servicing our clients in that area. And then, of all places, to have an office in Michigan and Illinois. And Christy Behunen, who is we'll talk about in just a minute, has really developed some great relationships in our Michigan area, in the Midwest area. We have here today Kaylin Cottrell and we have Paul Jude. Will you two stand? They're here from Michigan. Here we go. Paul's right here. We got Kaylin back here. These two are just the beginning of what's going to be great as we expand into that area of the country. So I want to put a map up here so you can kind of see our growth. I've tried to highlight, we just were introduced to Paul and Kaylin, and you can see a lot of clients that have come on in Illinois. We have well over 350 to 400 clients now that are up there, our Phoenix area, up in Washington, and of course, Texas, and our office locations. We have other strategic areas we're looking at this time. But our greatest asset at Soltis really is our employees. And so I wanted to highlight for a minute the talent that's really come to Soltis Investment Advisors that's helped us to go to new heights and to really, expand our reach, our brand, and our value proposition across the country. In our St. George office, I do want to highlight this whole conference was led by Clark Taylor. Clark, will you stand? Clark is over our wealth management division. And so grateful for Clark Taylor. Clark has been instrumental in this growth, right in the middle of it, his talents and abilities. And we're grateful for his leadership. You'll get to hear from him next. But I personally want to thank him for all that he's done for the firm. Tyler Finlandson, will you stand? Tyler's over our institutional and our retirement plan business and managing partner, and grateful for his leadership on we call it the other side, but they work really well together, the retirement plan and the individual high net worth divisions. Tyler Wilkinson, I don't think he's here, but Tyler Wilkinson has been with the firm from almost the beginning. He is our CFO and Chief Compliance Officer, and we're grateful for his leadership. Is Kelly and Sharon here? Kelly Homestead, will you stand? And Sharon, there is our operations manager, and Sharon is over our customer care. Sharon's been here from the very beginning of the firm, so 28 years, and Kelly's right behind her at 5 or 6 years. And they do a lot in making sure that our operations and our customer care is in line. So we're great for them. I highlighted Bill Wallace, but we have a great investment committee that has an average of 23 years of experience. That's the average with our investment committee, and there's a lot of experience that is on this investment committee, and we appreciate Bill Wallace and his leadership and leading the investment team today. I want to announce, this may be new to some of you, but we have a new partner, and her name is Christy Behunen. Christy, will you stand? She's over here. Christy joined us in 1997. I'm sorry, Christy, but she joined us just in, when was it? It was in 2017. I'm still in the 1990s, sorry. 2017, Christy joined us. A lot of experience at Fidelity and also in various businesses that she's been involved in. Christy's had a profound impact on the growth and the success of this firm, and we're grateful for her and for her becoming a partner here at Soltis. So get to know Christy if you don't know her by now. Our managing partners, you can see, as I mentioned, we do have a succession plan in place. You can see the managing partners of the firm, starting with the original founders, Lon and Hal, and it's been expanded now to more owners within the firm. So in just a minute or so that I have left, I do want to highlight just a couple of things, and then we'll turn some time over to Clark. We have and are very passionate about our mission statement to create, build, and manage wealth so that you can pursue your most important endeavors. I love our mission statement, and all of our employees do. It really is to support you. So thank you for being here today. We hope that in some way we are helping in a good way to manage your wealth so that you can pursue those most important endeavors. We do have core values that are very important to our firm. and they're on our website, but I just highlight them here. Very important that we're focused on our governing values. And I just want to end with 2 or 3 of them that are very important today as we've met today. First of all, integrity. To have the courage to make tough decisions that are consistent with our core values. We live in an interesting time, don't we? And to us here at Soltis, our governing values are very important. In this business, you have to make tough decisions. And as I look over the last year, year and a half, there's been some tough decisions that have made, and we've had to stay true to our discipline and to our core values. Knowledge, you're here today. We want to always recognize the power of what worked yesterday. I wanted to give a little bit of flavor. There are a lot of new clients here of some of the strategic decisions that have been made at Soltis in the past, what's working now, and what we see into the future as we continue to move forward. But knowledge is very important to us. You're here to gain more knowledge of what's in your portfolio, well, all the many things that are happening behind the scenes with your money. Fun. I hope you had fun yesterday. It is a core value, and we added that. We really do believe that it's important for us to create an environment that's enjoyable, not only for our clients, but our families and our business relationships. And we have our business relationships here, our clients and our families, of course, are very important to us. Wanted to just highlight this community service. We really believe in giving back to the community and being focused on service and giving back as an expression of gratitude for the many blessings that we have. And we have contributed this past year to many great foundations and organizations that are making a difference in our community. So thank you for being here. I am so grateful for those that have worked hard to put this conference on. Grateful for the sponsors that are here. You're going to hear from some great talent in our industry and some of our employees that are doing great things for your portfolios, and just grateful for each of you for being here today. So I'm going to turn the time over to Clark Taylor, again, managing partner and over our wealth management division. We're grateful for Clark Taylor. Let's give him a hand as he comes up.
Well, I think we'd be remiss if we didn't all maybe recognize Kim Anderson, our president CEO. If you'll join with me in giving Kim a hand as well. I think one of the things that we talk a lot about at Soltis and that we love is culture. And hopefully you get a little sense of our culture. And I can tell you that, I don't know why I'm feeling a little emotional. Our team responds well to Kim and they appreciate his leadership, and I certainly do. I wanted to just talk a little bit about some of our evolution, some of the how we've kind of evolved over the last couple of years. Kim alluded to some of the investments. We love to talk about our theme and ascending to new heights. We're committed to joining you in those new heights. But a couple of quotes that I have recently spent some time thinking about. In the middle of every difficulty lies opportunity. That was Einstein. Obstacles are those frightful things that you see when you take your eyes off your goals. And so certainly there's obstacles, but I think if we can have focus and have vision, I think we can accomplish a lot of good. So in our wealth management services, we can include things like tax. We try to coordinate with the good estate planners. We've got a couple of estate planners that we'll hear from later today to give us a little bit of update on what's going on in the world from an estate planning standpoint. But I want to take a few minutes and talk about a little bit of our investment evolution over the last couple of years. I first can't do that without just reminding us of the strength of our team. All of you, our clients, have a team that might look something like this. A team with Sharon, or a client relationship manager, with someone like Tyson that can help make sure that all of the reports are prepared and joining in on those reviews. And of course, the investment committee that's helping to make those decisions, and then the advisors that can implement those decisions for each client. We have our core models. These core models have been in place since 1993. They've performed well. They're risk-based models that we can use to kind of build a core that have a blend of traditional equities and traditional fixed income or bonds. These core models have performed well over the last couple of years. If you blend it against a benchmark of the Barclays Aggregate Bond Index and also the MSCI All Cap World Index, there's nothing wrong with the core models, and we're grateful for those models. Over the last 3 years, you can also see that they've done fine. So a core model, this is our 80-20, our balanced growth model that some of you may recognize, and that's kind of historically how it's looked. We've created as a team and worked as an investment committee, and appreciate Bill and Hal and our investment committee and all the work that our team's been doing. We've had some objectives to try to create additional customization and allow clients to tear that up, tear pieces of that and put it in different ways. But still, as a firm, we wanted to be able to operate efficiently, to be able to get trades done, and to be able to be nimble in making sure the portfolios are doing what they need them to do. We've wanted some additional tools as the markets have evolved and to be able to achieve our goals and objectives. We wanted to be able to incorporate individual securities, individual stocks into portfolios if desired by clients or for tax reasons or for whatever reason, to have that flexibility. We wanted to recognize the strength and the power and the opportunity in non-traditional asset classes. And so access with the democratization of the industry, where we can get into some of these really interesting private equity or private debt or real estate debt strategies that are available to us now that weren't a few years ago. And so we wanted to be able to access those powerful asset classes. I mentioned the democratization of these alternative investments. In the past, it might take 5, 6, 10 million to be able to access a strategy now where it can be accessed at much lower levels. And of course, we wanted to, as we look ahead and look at uncertainty, we wanted to have additional hedge opportunities against market downside. So we have tried to increase a portfolio. Bill Wallace, our Chief Investment Officer, in his experience at KeyBank in the past, has managed a portfolio of individual equity income stocks that's done really well for several years, and we've spent a lot of time focusing on that over the last little while. Hal Anderson has developed a growth stock portfolio where individual growth stocks, some of America's leading companies and names that are available to be in the portfolio. And then Sean Woods, our Director of Investment Research. Sean, are you here? Sean, do you want to stand? Where's Sean? Sean actually, I think, is in between. He's had a double of the funeral today. So Sean has developed a hedged equity portfolio. We've developed structured notes where there's opportunity to capture market participation on the upside and also try to hedge against the market downside as well. We're going to hear a little bit about digital assets and a portfolio that's been created that there's a lot of interest in what's going on with Bitcoin and crypto assets. And so we'll hear a little bit about that later today. And then we've had some factor rotation where we can take a part of our large cap portfolio equity and have it be a little more dynamic, or put trailing stop losses on it, or things like that. So that large cap portfolio that I just showed you, that balanced growth, we can take that gray piece of the pie and we can exchange that out or include in some of these additional strategies that we just talked about. If we want hedge, we can get structured notes. If we want additional income, more dividend yield, we can go with Bill's equity income portfolio. If we want to enhance maybe some of the growth and use some of the individual securities, we can include that as well. One of the things I wanted to try to accomplish during this quick presentation today is to give you some things or some ideas, so when you have your next review with your advisor at Soltis, that you'll be able to talk about some of these strategies, or you can be asking about, well, you haven't told me about a couple of these ideas. How do we include those, or should they be included in the portfolio? Do they make sense as we customize and move forward? I mentioned Bill, the equity income stock portfolio. Grateful for that performance. The current dividend yield of that portfolio is 3.5%, which is substantially higher than the dividend yield of the S&P 500. So it's a good way to generate income and to be able to maintain exposure to some of America's greatest value. I mentioned Hal and the growth portfolio. There's been a lot of innovation there, and grateful for the opportunity we have to own some of those great companies and for what's been developed there. Barron's magazine, which is a pretty prominent publication here in our industry recently just did an article on digital assets and how it was featured in that article that you maybe want to take a moment and read. I'm happy to provide that to you if you need it. Sean, our hedged equity portfolio, again, trying to outperform the equity markets when markets are going down, and then trying to outperform the bond markets when there's up markets in the equity. So trying to have maybe less volatility in the portfolio. So you're not capturing all of the upside, but you're certainly not capturing as much of the downside. So that's an interesting idea. The structured notes, just to give an example, many of you have used structured notes in your portfolio. If you haven't, we're happy to talk about those with you. But for example, we can purchase a 3-year note. So you make a 3-year counterparty, a bank, and they may give you 110% at that outcome in 3 years, 110 or 115% of the upside of a certain index, whether it's the Dow or the S&P 500 or a small cap index. And then they might be able to provide a 30% barrier on the downside that gives some market participation. If at maturity at 3 years, if we're within 30% of that initial purchase price, we've got protection of the principal. So there are some interesting ideas that we're happy to make sure that you understand, and whether or not it's appropriate to incorporate those into your portfolio. Kim and I have developed some work with some of these the dynamic sector portfolio that uses low cost ETFs. We've had Lunt Capital here in the past. Lunt has developed some really good factor rotation where you're in different factors within the S&P 500, and it's also a good large cap component of the portfolio. So that balanced growth portfolio might look something like this now, where the orange on the right side is that core balanced growth, where you have the diversified asset classes, the traditional asset classes, but there might be an allocation to private alternatives now, a real estate debt fund or a real estate equity fund or a private equity fund. You're going to hear from a few of these individuals today, and many of them are here. I'll try to introduce a couple of them here in just a second as we wrap up. But that portfolio is flexible. There's customization, and we want you to be able to put that into your portfolio the best way that it fits for you. We mentioned these alternatives, the way that they can help manage risk. We look at, there's many ways to look at these. One way is to maybe try to enhance return. We also want to make sure we're trying to enhance risk and understand what the risk adjusted returns look like as we build these portfolios. Some of those private alternatives are here. We've got, I don't want to, with all respect to our core portfolios and our traditional managers like Oakmark and Wasatch, we've got the Hartford funds, we've got First Trust we're going to hear from next. Franklin Templeton's here. They're the core. They've done a great job for us historically. I just want to introduce just really quickly for your benefit, if you want to have a chance to corner the guys at Green Lake. Where's our Green Lake team? So if you want to talk Green Lake, back here in the back, our CNL, Jim, where's CNL? So if you want to talk to Jim about CNL, there's Jim and his team. Sundance, Ryan Boffman, where's Ryan? Karina, we've got our Sundance team. If you want to talk to Sundance, they're here. We mentioned, Fidelity, Case, our teams are all here. Taylor Derrick is here in the front. We're going to have a chance to hear from Taylor Derrick. If you're in their Opportunity Zone fund or their debt fund, you can talk to them specifically. We hope that you'll have that opportunity to network. We're grateful for, again, for First Trust. We'll hear from them in a second. Chris Segolini from the Texas Oakmark. If you want to see how Oakmark has done over the last year, they've done great. He's been here as well. So we're grateful for these team members. Kim mentioned the Opportunity Zones. We're going to hear from Griffin. Our Griffin team's back here. Where's Griffin? If you'll raise your hands, we're going to hear from Griffin as well here in just a minute. Talk a little bit about Opportunity Zones. If you're sitting on some capital gains right now that you're looking to realize, now through the end of the year, there's some pretty, I would say, the legislation continues past the end of the year, but the time is probably now if you're looking at trying to do some Opportunity Zone work, which we think is pretty compelling. So we're excited to hear from Griffin in a few minutes as well. So with that, I hope I haven't missed anybody. I think I'm looking around. If I have missed, raise your hand. So thank you again for your time. We'd like to have Bill Wallace, our Chief Investment Officer. Bill, if you'll come up and introduce First Trust. We're grateful for Bill and his leadership on the investment committee. He's been with us for several years now, but he's been in the business a long time, and we appreciate the many experiences he has to share with us. So thanks, Bill.
Thank you, Clark. My opportunity today is to introduce our speaker from First Trust. And to do that, I want to step back and provide a little context on why would First Trust be here today? Why would we invite them to come? What you're seeing up here is our effort at trying to articulate how we try to take all the information that we have access to. We live in a world where data is robust. And one of the challenges that we have as investment people, and probably all of us in general, is how do we take all of the data and all the information that's out there and distill it into workable decisions. So the quote here I have is from Carly Fiorina, which I think kind of articulates what we're trying to do in the investment process. The goal is to turn data into information and information into insight. I in my mind, I've been around long enough to the pre-digital age when we got investment reports in paper. And I can think of the investment person who has, stacks of reports 3 or 4 feet high on their desk. I think that's a good visual of how there's too much information. Too much information can be bad. And so our goal is to take there's loads of information. At some point, we have to say enough's enough. More information can become the proverbial analysis paralysis. So what we've done here, you see, we kind of focus on economic information. How do we gather that information? Asset allocation information. So those are 2 really important components to the overall asset and investment decision-making process that we implement. So basically what we decided to do is really hone in on some firms that we really have respect for, and they kind of come about it from different angles. So for example, on the economic side, we use JP Morgan Asset Management, First Trust, Ned Davis Research, and T. Rowe Price. And each of these kind of have a different element of what they bring to the table. JP Morgan and T. Rowe Price are obviously asset managers themselves. So they're kind of, they have to put the money where their mouth is. First Trust, we really look to for economics. They're providing investment management service as well. Ned Davis Research is particularly unique in this group in that this is research we pay for. One of the things that we want to make sure is that the research we use is objective. And, we talk about conflicts of interest. I think one of our big goals is to avoid the conflicts of interest so we can make decisions which are in your best interest. And when you pay for research, that's the least conflicted group that we can think of. That's the economic side. The asset allocation side looks pretty similar, with the exception of we use another group that's called market intelligence. Again, and this is kind of a consensus gathering group. So they look at a lot of different firms around the country and what they're doing to, what kind of is a consensus viewpoint of what could be happening coming down the road. So as you think about that, of kind of funneling all of this information, that's wonderful to have, but again, that information can, at some point, more information is not better. So we funnel it down and we come up with our economic outlook and also our asset allocation outlook, which informs our tactical decisions. So we believe in strategic allocation. We're going to have target weights for our clients. But we also want to try to add some value in our investment decision-making by having tactical. So you'll hear us talk sometimes about overweighting equities or underweighting fixed income. That's kind of what we've been doing for the last 12 months or so. Maybe 18 months, we pretty much went that way when the market crashed during COVID. So that's one of the reasons why First Trust is here today. They're a firm that we use, that we value their insights, and we consider them a partner, if you will, in what we do. So let me now introduce Bryce Gill. Bryce is an economist and is part of the First Trust Economics team that Bloomberg has ranked as one of the top forecasters of the U.S. economy over the past several years. At First Trust, Bryce is responsible for analyzing economic indicators, writing economic commentaries, and producing articles on the First Trust Economics blog. He is also one of First Trust's national speakers traveling around the U.S. to present timely information on the economy and financial markets to both professional and everyday investors. Cogent's 2017 survey of advisors rated First Trust thought leadership material as #1 for most read and most shared by the financial professionals with colleagues and clients. Bryce is based in First Trust Austin, Texas office and received an MBA from the University of Texas McCombs School of Business and a BA in economics from Miami University, Ohio. So with that, please join me in welcoming Bryce Gill.
Okay, fantastic. Oh,
well, hey, can you hear me on this? Oh, there we go. All right. Well, hey, everybody. Thanks for joining us here today. My name's Bryce Gill. It's an honor to be able to kind of kick off the conference here. And, in a lineup that has so many great highlights of alternative investment opportunities, I think it's important to kind of set the stage with the traditional asset markets, stocks and bonds and what to expect here. And, as you can tell from the title of my presentation, I think we are starting to kind of hit this inflection point with the Federal Reserve, saying they're going to taper their asset purchases. We've seen volatility returning to the market. And, it's interesting. I sent this presentation to Bill about 3 weeks ago before these markets started going crazy again. And it looks like things have started to get volatile, earlier than even I expected. So I think it is kind of a great time to take stock on what to expect in the traditional markets. Looking forward, what we should expect as the Federal Reserve kind of takes its finger off the scales with regards to interest rates. So, let's get into it here today, guys. The first thing I want to do, though, before I drill down into kind of the immediate issues in the asset markets and what we should expect over the next, 12 to 24 months, is I want to take a longer term view. And I want to give us some context because, we all have smartphones in our pockets. We've all got, a screen right in front of us all day long, and we're all getting, information pumped into our heads on a regular basis. And, with that fire hose of information, I think sometimes we lose context of the broader trends that are happening. And, when it comes to economics, sometimes the big broad trends are more important than some of the sexier stuff like the new spending bill in Congress or whatever it is. And when we talk about big overarching trends with the economy, there's maybe nothing more important than demographics. Okay. And this is something I think is just often completely overlooked. And I think we have a huge focus on, again, 12 to 18 months in the future. And we lose context sometimes of the broader trends. So what I want to talk about, just to set the stage for everybody here today, is demographics in the world. And specifically, with our major developed country competitors, that being Japan, Europe, China, and I've got the US up here as well, obviously. Obviously there's all these kind of existential questions about the United States and its role in the world. And will we be, the economic hegemon into the future, and will the dollar be the reserve currency of the world? And I think if we turn to demographics, there's some really great insights here, not only on those big questions, but also on asset markets as well, and where the best opportunities are going to be, well into the future, not just, for us, but also our children as well. And what I have here is the working age population. So that's everybody 15 to 64. And why we care about this age group is because, when it comes to measures like GDP, production, which is obviously highly correlated with revenue and profits and things like that, the working age population is a huge component, right? It's going to be working age population growth and productivity growth that ends up resulting in, overall output. And I think most people are very familiar with Japan and kind of the situation that's been going on there since the late 1990s. Their stock market peaked, same time as their economy kind of peaked. Things have been heading sideways since then. I think it's really interesting to note that that's right around when Japan's working age population peaked as well. And so, that's just one example of how demographics can give you kind of a head start on, what's going to be happening in equity markets in certain places around the world. But what's really interesting right now is that we're at a huge inflection point in the world, because our biggest competitor in the world is China. This has become kind of a bigger part of the national consciousness over the past several years, starting with the Trump administration, now with the COVID pandemic and other things like that. China's biggest advantage for the past several decades, really since they joined the World Trade Organization, has been their massively growing demographics, right? They have a huge glut of labor, and that gives them a big advantage with costs and manufacturing and all these other industries. Well, I think it's really interesting to note that China's working age population is currently hitting its peak and is set to decline now through the end of the century by about 40%. And it cannot be overstated how big of a headwind this is for the Chinese economy. Okay. Again, I'm looking at these demographic numbers. I'm seeing huge parallels with the Japanese equity markets as well, and kind of the Japanese demographic situation. On top of that, we have the Chinese Communist Party cracking down on their tech firms, a lot of their major equity, major parts of their equity markets as well. I look at China and I see them going forward as having huge problems, not only, with regards to their equity markets and their, local economy, but also, in their ability to remain competitive with the United States into the future. And I think we're all familiar with kind of the demographic problems in Europe as well. And you can see that on the screen. And so when I look at these demographic numbers, I really think that Europe and China are kind of heading in the same direction as Japan. And I think, it makes me overall rather bearish on those markets. And, what's really the standout here, to me at least, is the United States, right? Because not only are we the only, we're the only major country here with our working age population that grows through the end of 2100. And I think most people know that, hey, fertility is below replacement in the United States. This is a problem. But the reason our population is going to continue to grow is immigration. It's a huge advantage for us. Everybody wants to come to the United States, right? We still let in absolute terms, more than anybody else in the world, more people. It's a big reason why I think competitively, we have a huge leg up on, everybody else in the world. And, it's a reason why I expect the dollar to remain the reserve currency, and also US equity markets to continue to outperform into the future. So I did want to give this kind of broader context, because I do think that we're going to hit some bumps in the road here over the next, again, 12 to kind of 18 months as the Fed kind of exits from the market in a big way. And that's where I'm going to kind of shift focus to now is, what to expect here in the United States. And, before we can talk about interest rates, I think we got to talk about, and I guess this informs corporate profits as well, which we'll get into, but we've got to talk about inflation and what's going on, right? Because inflation has been coming back in a way that pretty much nobody expected, at least with regards to the experts. First Trust was maybe one of the only major companies calling for a burst of inflation, and that was going to be more and more, more lasting. But this is a major reason why we thought this time was different than, 08, 09, for example, when everybody was talking about the Fed printing money and hyperinflation. And we obviously know in retrospect that never ended up occurring, right? If anything, we had problems with inflation kind of running below that 2% target. And I think this chart goes a long way in kind of demonstrating why inflation is different this time around, okay? What I have here is U.S. personal income. That's that line there in blue. And I've also created a long-term trend of personal income in the United States as well. So I'm basically saying, hey, let's assume 08, 09 never occurs. We just grow at that 5-6% rate in perpetuity, just so we kind of have a comparison point to look at, right? And what we see is that in 08, 09, it's a typical example of a recession, right? Unemployment starts to rise, personal income falls, and what's really interesting is that personal income remains below the long-term trend for 10 years, right? And this is why we had one of the slowest recoveries in US history. This is why we couldn't hit our inflation target. This is why we're talking about secular stagnation and all these permanent problems with developed economies. But if you come over to 2020 and 2021, I use this chart almost every day talking to clients and investors around the country. And this chart really blows my mind just every time I look at it, because not only did we have, we had 3 times the job losses of 08, 09, but personal income in the United States never fell during this pandemic. In fact, America got a raise, if anything, at least in nominal terms, right? And you can see the 3 distinct spikes in personal income from the CARES Act and the Trump stimulus, and then the Biden administration's $1.9 trillion. We've spent about $5 trillion on COVID stimulus in the past year. And for context, that's about what we spent in inflation adjusted terms on all of World War II. Okay, so we're talking about a huge amount of money has been dumped into the economy. And whereas in 08, 09, the Fed printed money and it just kind of sat in bank vaults and balance sheets and never really entered the economy, never got lent out. Well, this time around, we're sending checks to individuals, right? Stimulus checks, boosted unemployment benefits, PPP loans. And at the end of the day, the demand side of the economy has never been better in the United States. There's more money in people's pockets than ever before. But there's 2 sides to the ledger, isn't there? Right? It's not just all about demand. The supply side of the economy is obviously having serious problems right now, right? And we're seeing that with supply chain issues. We're seeing it with a huge labor shortage. We're seeing it, kind of across the board. And the bottom line is, this is just an Econ 101 situation, in my opinion, okay? Demand is running way ahead of supply on a consistent basis. And that's why we're seeing price increases kind of across the board, okay? So I think that's what that's what's causing all this inflation. And really the big question to me is, how long is this going to last? When will supply chain issues iron themselves out? I wish there was a scientific or an empirical way to sit down and determine that, but nobody knows, right? And in the end, my big question is: do we keep stimulating the demand side massively going forward with multi-trillion-dollar spending bills? And I mentioned that $5 trillion we've already spent, right? We're currently debating another $4.5 trillion as we speak today in Congress. So to me, it doesn't look like the pace of demand stimulus is slowing down all that much. And if we do continue to pass these bills, I think let's expect inflation to continue to run hot as we get into 2022 as well. So this is just kind of adding to what I was saying, that the experts in general. It's funny when you watch like CNBC now, or you look on Twitter, everybody's saying, hey, we all expected this to happen, right? It's all transitory, it's all short term, but hey, everybody, we knew this was going to occur. And it's really funny because when you go back and actually compare the estimates and the track record, it shows the exact opposite. It shows that this is a completely unexpected burst of inflation, at least the magnitude that we've seen, okay? And what I've got here is, it's called the Citi US Inflation Surprise Index. And all this does is it takes the actual readings for inflation for things like the consumer price index or the producer price index, import-export prices, and then it just subtracts the consensus estimates before the numbers were released from that measure. So, hey, if inflation's coming in way higher than consensus on a consistent basis, this index is going to rise, and if it is below consensus consistently, this index is going to fall. And going back to the 10 years after 08, 09, you can see us missing our 2% inflation forecast constantly, right? And economists were always estimating that inflation was going to be higher than it was. Well, this time around, we've got the exact opposite situation occurring, and to a next level of magnitude, right? So inflation has been coming in way hotter than expected consistently throughout this year. So I think this is something we all need to keep in mind when we say that, hey, we know this is all going to be over soon, or This is all going to be a temporary phenomenon. It might be true, but my big point is there's a big risk to the other direction. The unknowns are bigger than ever before, at least regarding price increases, and that's an added risk, I think, to interest rates, especially as we get into next year and the Fed begins to taper its asset purchases, right? So something to keep in mind there. So with that, guys, let's talk a little bit about interest rates, because when we talk about things like equity valuations or the bond market, obviously a huge component of valuation there, right? And what's really interesting is when you look at real interest rates, the situation seems to be a little bit divorced from reality, at least in my opinion. And what I've got here is the US 10-year real yield, okay? And I'm just using core CPI to calculate this, which is a pretty typical way to do it. But early on in the pandemic, we see real interest rates start to fall into negative territory, or at least farther into negative territory. And that's something you would expect, right? This is an unexpected pandemic. We don't know if we're ever getting a vaccine. We don't know how permanent the damage is going to be. But we start to get things under control. A vaccine becomes available, and interest rates start to recover, and we actually get back to around 0% on real yields, right? Which is, I saw you laugh there, sir. Which is, it's funny that that's like the standard of like a positive outcome or whatever as investors. That's how beaten down we are by this hunt for yield or whatever. But what's interesting is that since these really high inflation rates have started to hit the tape, real yields have absolutely collapsed, right? And we're currently where we're at today at a lower real yield, by far than we were early on in the pandemic, in the dark days of like March of last year when the outlook was completely clouded. We're in the middle of the fog of war, right? So to me, when I look at this, one of two things has to happen. One is nominal interest rates have to start to rise, which we've begun to see at least a little bit in the past couple of weeks, at least since that Federal Reserve announcement that they think they're going to start tapering soon, or inflation is going to have to fall off a cliff. And is that possible? It is possible, but again, that's a big unknown. Going forward, my guess is, it's probably going to be a combination of both, but look for nominal interest rates to continue to trend up, especially as we get into next year, right? Recently, rates have started to rise. The Fed said, hey, the taper is probably going to start in November, or at least that's what people have been saying. That's how they've interpreted the comments. My opinion is, I think this taper gets kicked off until next year. I think they kick the can down the road for a couple of reasons, okay? One is we just got another bad job market report this morning, okay? And the Fed is very, very focused on a full recovery in the employment situation before they start to, taper their asset purchases. So that's going to be, one strike that they're going to be looking at. We've had two bad job market reports in a row. The second is, if seasonality holds with regards to COVID-19 and the Delta variant, then we should expect to see rising case numbers in the fall and the winter in the northern states, just like we did in 2020. Okay. And if that happens, I think that's another kind of the Fed's going to look at and say, well, hey, maybe we should hold off on these asset purchases until the case, situation looks better with COVID-19. So that's kind of my baseline. Members of my team disagree with me. So, keep that in mind. We're having a vigorous debate every day, but broadly speaking, we know the Fed is going to start to raise interest rates soon. And that's obviously a headwind for, equity valuations and, the value of, face value of bonds and things like that as well. So something to keep in mind, a big reason why I think we've seen so much more volatility in the markets here over the past couple of weeks. So, that being said, guys, the interest rate situation, I think, is adding a lot of risk to the plate, especially after we just enjoyed, 9 months of completely sanguine equity markets that are trending up every single day. But, the flip side of the ledger here is, interest rates may be rising, but I do want to point out that corporate profits have just been absolutely booming during this COVID pandemic. I guess early on you saw that they collapsed pretty significantly, but within one quarter, we were back to record highs on corporate profits. And this is through Q2 of 2021. Corporate profits have been absolutely booming, guys. And this is a huge, I think, fundamental positive for the equity markets right now. I think it's a big reason to kind of be optimistic through year end. People still have a huge amount of saved money in their pockets. A big reason corporate profits have been booming is that huge increase in personal income I showed you guys earlier. And I think it's important to keep in mind that that huge increase in personal income, a lot of it's just been sitting in people's checking accounts, waiting for consumer confidence to return or this virus to finally permanently be gone. And eventually that money is going to enter the economy. And I think that's another reason to kind of be bullish about corporate profits, even if we are kind of worried about a fall and winter COVID wave or kind of a bad holiday season over the short term, right? So with that, guys, I'll just turn to our look, what we're thinking about for the equity markets, right? So what I've got here is our forecast over the years, starting in 2006. And you can see the little dots are the forecast for the Dow and the S&P 500. And then I've included the equity indices as well. So you can see our track record over time. And what we're using to make these estimates, we use a different methodology than most of Wall Street. Most of Wall Street does an EPS forecast, earnings per share forecast, and they apply a multiple to it. We actually take corporate profits as reported to the IRS, and then we discount them by the 10-year treasury. And we do this back to the early 1950s. So we have a really long track record of data, and it helps us identify periods of over and under valuation. But this capitalized profits model has done really well over the years. And I think the major reason why is we're building interest rates, which again, are a very fundamental component of equity valuations directly into that model. And we're using a 2% 10-year when we make this forecast. So we're actually being pretty conservative here, with the 10-year currently at 1.5%. So something to keep in mind, we are building, being conservative when we make this estimate, at least in our assumptions. And we're looking at the S&P 500 to end the year at about 5,000. So we do think that there's still upside to the markets here. And again, the biggest reason, in my opinion, is the Fed kind of kicking the can on this taper. So there is kind of some risk on the table there as well. But I really do think, as I kind of look into the future and we get into next year and we see the Fed kind of taking its thumb off the scale on, treasury purchases, which, by the way, they're buying about 60% of the overall issuance of the U.S. Treasury right now. So a huge, huge influence on the market, right? They're going to be taking their thumb off the scale. In my opinion, inflation is still going to be running above that 2% target as we get into next year. Those two kind of components together, that really raises interest rate risk, I think, as we get into next year. And obviously, I don't think that the massive boom in corporate profits that we've seen this year, that can't continue into perpetuity, right? So slower earnings growth, rising interest rates, to me, that's a kind of a perfect combination for more volatility in the traditional equity and bond markets. And, again, kind of a great reason to be considering alternative investment opportunities as we get into, this kind of normalization of interest rates and kind of start getting back to normal. So with that, guys, I'll just finish on this slide. What you can see on the left side there is an example of our flagship piece of research. We call it the Monday Morning Outlook. Every Monday, we send out a one-pager on a big event or kind of narrative that's going on in the economy. It's always one page, always easy to read. It's client approved. You can share it with your friends or your relatives. No problems there. I think it's a great resource. We also publish on every major piece of economic data. And feel free to just Google First Trust Subscribe. Everything's free and available to all of you. If you'd like that. My contact info is up there as well. And if you don't want your inbox getting hit with a bunch of emails on a consistent basis, feel free to follow me on LinkedIn. I post everything there as well, and that'd be another easy way to get access to this stuff. So thanks, guys. It was great being with you and being able to share some comments. And I'll go ahead and turn it back over to our gracious hosts at Soltis. Thanks.
Oh, yeah, absolutely. I think we have a minute or two to still take a couple of questions for Bryce. Happy to. Are there? Yes, sir.
Yeah, so the question is about stagflation, right? And a lot of people are getting worried about this because, hey, we're seeing inflation that's pretty much like the highest since the 1970s, or at least there's a lot of parallels to certain people. So right now, I think it's probably not likely that we're in a long-term stagflationary situation. I think a big reason why these have been making headlines, this term has been, is because the Federal Reserve has been raising their interest rate forecast, which in my opinion, they've just clearly for political reasons have been playing down for a long period of time. So they're finally raising their interest rate forecast and they're dialing down their GDP forecast for the end of this year because, again, I think they're anticipating a rise in COVID cases. So I think it's more of a short-term problem. I do think as we kind of get into next year and, again, hopefully this pandemic is finally under control and we can all kind of leave that in the past. And, half the country seems to be kind of locked in a COVID roller coaster, honestly, where every 6 months we kind of batten down the hatches again. I think if we can get past those short-term issues, I think we are kind of primed for, an economic boom. There's just so much, money sitting on the sidelines waiting to be spent. And, if we can get people back to work and, fears about the virus decline, I think we do have an opportunity to have a pretty fast economic recovery here. So I don't think we're back in the 1970s yet, or at least regards to stagflation. Yes, sir. Yeah. So the question's basically here. Why is the job market? Why are we getting these terrible reports when we've got more job openings than unemployed people in the United States right now? And part of it was the fact that people just got a huge amount of cash and they're sitting on a big cash balance, and there's not as much urgency to go back to work. Maybe people move back in with their parents from the city or whatever, and just kind of still hanging out there. So that's part of it. But also, I think the fact that half the schools in the country are still closed or are doing partially virtual or hybrid. Parents rely on the public school system in a lot of this country to be active participants in the labor force. I think that's a big impediment as well. And then, fears about the virus are part of it, too, right? I think, again, we see every 6 months there's a rise in cases. The news only covers when cases are rising, never when they're falling. It's kind of, I think it's just part of the news business model, right? Fear and kind of bad news sells better than good news. So that might be part of it as well. And honestly, I don't know how we extricate ourselves from, the current COVID situation. If vaccines are not enough to kind of end the state of emergency, then I really don't know what it's going to be at this point. So that's kind of my personal opinion.
Can you talk a little bit about potential ramifications with tax law that's potentially changing? Yes. Okay. Yeah. So, we basically had a bunch of tax proposals get floated, right? And at least right now, at least as investors, in my opinion, the worst ones are probably off the table. That being, the end of the stepped up basis, for example, and raising capital gains to the same rate as income. Those look very unlikely to pass. So I think what we end up getting is an increase in the corporate tax rate, which I think has been priced in honestly since, early this year. I think everybody's assumed that corporate taxes are going up. We just don't know what the final number is going to be. So I think corporate taxes go up. I think, the upper end of income tax rates go up. And those are kind of the major, changes in tax rate proposals that I think that we actually see enacted. What would really have to happen to upset the equity markets in a huge way, in my opinion, aside from interest rates, obviously, would be either the stepped up basis getting repealed or capital gains going to the same rate as income. Those would be, I think, things that would rock the markets, at least over a short period of time.
Bryce, thanks again. We're going to take a short break. We've got some refreshments and restrooms are I think right around the corner, and we'll try to start back up right at 9:50.
I want to first thank Kim Anderson, our CEO and president, and our partner team. I'm grateful for each one of them and the leadership that they provide the firm. We're very grateful, of course, for our sponsors here today and ongoing. They're not just sponsors for a concert, they are for a conference. They are critical components to your portfolios. And most especially, we're grateful for your clients. thank you so much for supporting us, and it's a privilege to do business with such fine people and your families. So today, my part of the presentation will be about digital assets. And I'm not sure we fully understand how awesome it is to have Matt Hogan here from Bitwise. And I'm going to be turning the time over to him in just a few short moments. But he is a thought leader and a practitioner research, one of the leaders in the digital asset industry, which is, emerging. So let's dive in. There are some skeptics among investors and those that we respect. And I'm not going to go through all these quotes. You can kind of see them, but Warren Buffett doesn't think much of crypto yet. And I say yet because all of us kind of have to either decide. And, I've been skeptic over time, but as we learn and we see that $2 trillion is the market capitalization, and Matt will correct me if it's gone up from there. But as an example, capitalization of gold investments is 10 trillion. So 2 trillion, 10 trillion, it's making its mark. Well, what is crypto? You probably all know, but it's a decentralized money, digital money designed to be used over the internet. So it can be done fast, it can be done very cost effective. And if you use Venmo or PayPal or so forth, you're using that blockchain technology that's part of this. So it's emerging. I'm going to quote Bitwise here quite a bit as one of the industry leaders, but notice, equities and bonds, we've been just talked to by Bill and the First Trust team about, the traditional investments, equities and bonds, and what drives their value. And you'll notice crypto assets are on the right here. One of the main things that's driving this is an uncertainty with the spending that takes place at government levels, right? And there is a weakening trust in that kind of authority. When I think of it, it's kind of like a rebellion of the upcoming generation to overspending and fiat currencies, which devalue, of course. Well, there's been institutional adoption when Fidelity starts to make these comments, one of the great titans in the industry. They say, hey, digital assets will soon be recognized as investable stores of value, and that there needs to be professional custody solutions. And that's where Fidelity has been playing. They custody one of the premier custodians in the industry. And then this last comment here is, we believe securities will become digitally native, and they aim Fidelity to be ahead of the curve. In other words, they're going to be ready to participate in that. This slide, I'm sure, is dated, but notice some of the big corporate institutions that have made investments or are participating. JP Morgan, PayPal, Bain, Tesla, Mass Mutual. This is a conservative insurance company buying $100 million in Bitcoin as part of their portfolio. Okay, so when this starts to happen, it can't be ignored. We have to understand it. By the way, I meant to make a comment up front. I am not an expert. Soltis is not an expert in digital assets, but we know who is. And that's why Matt Hogan will address us. But we are learning. We're doing our best to keep pace with all the markets, and this is one of them. Fidelity does a survey that's kind of interesting. Notice all the adoption. The US is actually behind the Europe and Asia in the adoption of digital assets. However, this is going forward. You'll notice that there's an increase expected in adoption over time in all three of those markets. Bitcoin and Ethereum are the leading cryptocurrencies. Matt will cover that more. What's the appeal? Why do investors consider this asset class? Well, number one is 43% say, well, it gives a good rate of return. It enhances rate of return. The second one is it's an innovative technology play, and that's true too. But this third one, that it's uncorrelated to other assets, is really where we find it to perhaps have the most value to portfolios for our clients. And to emphasize this, 49% of all that have been surveyed are prioritizing that non-correlation, but 69% of financial advisors like us think that's the most important part of adding it to a portfolio, that when the market goes up or down, there's going to be a different performance of this asset class. Now, we ran some correlations, and what we just do, you see the 3 and the 5, you can't see it, I know it's too small, but there's a negative correlation between the US dollar and crypto Bitcoin, okay? If you believe that the value of the dollar will depreciate over time because of too much spending and inflation and so forth, then you'll want to look at assets. Traditionally, it's been gold, right? But digital assets are also negatively correlated. This is why we have great interest in this asset class to secure value over time and to guard against uncertainty. Here's kind of a chart that kind of shows the major trend where the US dollar has declined and where the Bitcoin has improved in value. This is interesting research from Fidelity. The purchasing power of $1 back in 1700, before any of us were around, right? But this is just seeing kind of the mega trends. If you're in equities, you've done well. It's now worth about $4 million. Or is that billion? Looks like a billion, doesn't it? And then there's bonds that are the next asset class, and then cash, which right now cash is negative, right? If you look at inflation, as we were just taught by First Trust. And then down here you have inflation in the yellow line. Gold has kept pace with inflation over that time period, but what happens to your fiat currencies? Okay, worth 2 cents. Okay, starting at $1 over time. And that may accelerate, right? We don't know what will happen with inflation and with just printing money to take care of debts, but we know it can't be good, right? Okay, here's Deutsche Bank. They put out their research. The forces that have held the current fiat system together now look a little fragile, and they could unravel in the 2020s. If so, that will start to lead to a backlash against fiat money and demand for alternative currencies such as gold and crypto. Interesting perspective. Well, why are we adding crypto to some of our portfolios, the growth portfolios? Here it is. This is, portfolio theory. The cumulative return, you can see the annualized return. The Sharpe ratio is a measure of return to risk. And so when you add small amounts, 1%, 2.55%, by the way, this is Bitwise research. Matt's done this research. But your Sharpe ratio increases, meaning your risk return profile is improved. Okay. This has to do with that negative correlation. And hopefully Matt will amplify this and help us understand even more. They did some rolling returns. If you held it 1 year over the time period here is 2014 to 2021. So the time period that we have good data, but you'll notice that if you've held it for 3 years, it's always been a winner over the last 3 years. And this is rolling periods of time, rolling 3-year periods, 2 year and 1 year. Even holding it a year, 77% of the time you have been up. So there's mass volatility. I'm advocating the very best way to structure portfolios for the long term to give you the best risk return experience and improve rate of return and reduce risk. And we believe that a small allocation to crypto has shown historically, and with some of the mega trends that are in place, will be important to the portfolios. The green up here, again, this is Matt's work. This is the Sharpe ratio on rolling 3-year periods with a 2.5% allocation to crypto. The green is the value provided by having that in the portfolio. Okay, so there's no red up there. So for rolling 3-year periods, it's always been an improvement. And again, here's the summary of their analysis. Crypto has had a uniquely valuable role to enhancing the risk-adjusted return of the traditional bond and stock portfolio. And that's why we are advocating it as part of our growth strategies. We've also created a digital asset portfolio. Bitwise, we've analyzed the the industry, and there's some great players, there's only a few instruments that get traded on a daily basis. And so we're somewhat limited in this portfolio because you can do private subscriptions, which for large investments and for you that are higher net worth, that makes sense. But on a more, to be able to bring it into a portfolio that's daily liquid, we have Matt and his team. We've anchored the portfolio in an indexed approach that Bitwise has pioneered and is the leader. They manage over $1 billion in this strategy, where they have created an index at 10 of the currencies, and that's 40% of this portfolio. Another 20% is an ETF that's newly been created that holds the top DeFi and blockchain companies that are gearing up to participate and are leading in that industry. And I'm sure Matt will cover that as well. So right now I'd like to introduce Matt Hogan. He's the CIO of Bitwise Asset Management. They manage $2 billion or so. And it's just, I mean, this is the guy that gets quoted all the time, every day in all of the publications. But we're privileged to have Matt here. Let's give him a warm applause.
Thanks, Hal. Thanks so much, Hal. That was an amazing introduction and presentation. I don't have to do much because Hal did most of the work. How's everyone doing? Good. This has been incredible for me to be here for the first couple hours of this. I feel like the values that Soltis put up at the beginning really resonated with me. So I'm really pleased. Thank you for the invitation, Hal, and thanks everyone for your time. We're trying to get the slides up here, but what I'm going to, of the presentations. There you go. Absolutely. While we're getting that up, I thought I'd tell you a few words about Bitwise. And just so you know where we're coming from, as Hal mentioned, we're a crypto asset manager. We're a specialist crypto asset manager. That's all we do. We've been doing it since 2017. We're the world's largest crypto index fund manager. So Bloomberg has called us the vanguard of crypto, which is a funny analogy, but we have been managing crypto index funds for over 3.5 years. We come from traditional asset management backgrounds. So you might have expected the crypto guy to be up here wearing a hoodie. Instead of blue suit, I went casual, no tie. I wore a tie yesterday on CNBC and a lot of people made fun of me. But we come from traditional asset management backgrounds. I spent 12 years in the ETF industry, was the CEO of ETF.com, built the world's first ETF rating system, built the world's largest ETF conference. Others of us come from JP Morgan, Goldman Sachs, BlackRock, and iShares, et cetera. Let's see, we're going to get the slides up. While we wait for that, let me do a little bit of a survey in here. How many people in this room own Bitcoin? Okay, great. How many people own an asset, crypto asset besides Bitcoin? Okay, one last question. No, 2 more questions. This is too fun. How many people think crypto is insane? Okay, great. We got honest people. Hal raised his hand. I love that. All right, let me see if I can stop you. How many people could explain crypto to their niece or nephew or their dad? We got 2 hands. I love it. Great. While we get these slides up, I'm going to try to do a few things. And if we don't have slides, we'll just do it like this. I'm going to try to explain to you what crypto is, what blockchain is, and why there's more than one crypto asset in a way that you could explain to your kids or parents. Because I'm a believer that if you don't have sort of a fundamental understanding of what something is, it's hard to allocate to it. I'm also going to explain to you something from Hal's slides. You know, when I left the ETF industry to move into crypto, I had to pause for a long time because a lot of my investment heroes, folks like Jack Bogle, Warren Buffett, people I really respected in my heart, said that crypto was worthless, was not valuable. And I had to make super sure why I had a different perspective. And I think I figured it out, which is that there are 2 ways to approach the crypto market. If you approach it from the angle of crypto as first and foremost a currency, you end up being fairly skeptical. How many people in here have bought a cup of coffee with Bitcoin? Right, no, none of you. I've never bought a cup of coffee with Bitcoin. I live in the San Francisco Bay Area, a tech forward place. I work at the world's leading crypto index fund manager. I've been in this space for 4 years, and I've never bought a cup of coffee with Bitcoin. Why? Because today dollars work very well for buying mocha frappuccinos. You don't need Bitcoin. Bitcoin is volatile. It's not accepted today in many places. And yet, I think it's a once in a generation technological thing. Because if you approach crypto as a technology, it's almost inevitable. And I'll give you an example while these guys, if you can't figure out the slides, guys, we can just go talking. I'll give you an example of what I mean. If you were to go to Bank of America's webpage today and say you wanted to wire $10,000 to London, the webpage would say it takes 2 business days. In other words, the earliest you could get it there would be Tuesday, and the fee would be 1 to 4%. That's what they're advertising on their webpage. By comparison, the other day on the Bitcoin blockchain, someone moved $1.1 billion. It settled in 10 minutes and the fee was $2.50. Now just click for a moment on that. You have one of the world's largest banks, 250,000 employees, offices in 38 countries, a high-paid CEO, a high-paid tech team. The fastest they can move $10,000 to London is 2 business days. They can get it there by Tuesday. You're better off getting on a plane with a suitcase full of cash. By comparison, you have this software network with no employees, no offices, no balance sheet, no CEO, and it could move $1 billion to anyone in the world, have it settle in 10 minutes. The fee is $2, and it works 24/7, 365. It doesn't go home at 5 p.m. It works all around the clock. When you approach crypto from a technological perspective, awesome. We got the slides. Thanks, guys. When you approach it from a technological perspective, it seems inevitable. We don't use it in our day-to-day currency today. But think about that Bank of America example. No employees, no offices, no balance sheet. It can move $1 billion anywhere in the world in 10 minutes and have it settle in 10 minutes for a fee of less than $3. Approached as a technological perspective, I think crypto is inevitable. Here's my agenda. I'm told we'll be on time. So here is Bitwise. There's pictures of me with a little bit less gray hair. We're a team of almost 50 people now, managing about $1.7 billion in assets. These are our backgrounds. We have a full advisor support team. We produce educational materials. I was fortunate to write the CFA Institute's Guide to Bitcoin, Blockchain, and Crypto. That came out in January of this year as an indicator of the amount of professional interest in the crypto markets. It's the most downloaded piece of research in their history. This one, I can't get this to work. Let's see if I can do it this way. All right. Great, awesome. I'm going to speak here because I can't get the clicker to work, so I'll just put that down. This is our fund. It's the Bitwise 10 Crypto Index Fund. This is part of that portfolio that Hal mentioned. It holds the 10 largest crypto assets. The beauty of this fund is you can invest in the space and not have to try to pick and choose winners. But let's do this. What is crypto and why it matters? Now, I explained that I don't think Bitcoin is about paying for coffee right now. It's about moving money over the internet. I gave that example of Bank of America. But what I haven't talked to you about is why it's able to do that. It's not because it's this sort of strange technology forward thing. It's actually a very simple example. And this is how you explain blockchain to your kids. This is how you explain crypto to your kids. Anyone use PayPal or Venmo? We all use PayPal and Venmo. 200 million people use Venmo. Why do we use Venmo? We use Venmo because I can send you $20 and you get it instantaneously. We use it because we can pay our babysitter, because we can split bills, because we can pay our housekeeper. Everyone uses Venmo. What no one thinks about is why is Venmo or PayPal able to move money so fast and traditional banks are able to move money so slowly? And the answer to this question actually tells you everything you need to know about what Bitcoin, blockchain, and crypto is. The reason Venmo is able to move money so fast is that Venmo is a walled garden. It's one database. Inside Venmo, Venmo controls every transaction. So if I want to send you $100 in Venmo, Venmo can look, it can see I have $100. It can transfer it to you as fast as you can change one line in an Excel document. It controls every transaction. So it knows I haven't tried to send that same $100 to everyone in this room. Because it's one database, it can move money extremely quickly. Banks are slow because there are thousands of databases. If I send you a check from Wells Fargo and you deposit it at Bank of America, Bank of America is not going to give you your money until they check with Wells Fargo. Does Matt really have $10,000? Has he written 10 $10,000 checks on one account? That process of checking between different databases is what makes the traditional financial ecosystem so slow. The reason it takes 2 business days to get money from here to London is because that money has to go through like 5 or 6 different banks, and they all have to check with each other. In other words, one database is fast, another database is slow. You've spent probably 5 years reading about crypto, hearing about it in the Wall Street Journal and on CNBC. But here's the thing, all you need to know, the whole key, what a blockchain is, why it's an innovation, is it's a solution to a computer science problem that existed for 30 years, that was debated at MIT and Stanford, that is in the computer science literature, which is how do you have one database like Venmo, but this one database is available everywhere in the world. Literally everyone with an internet connection can look at it, can see it, can verify that it's true. It updates in real time. Anyone can participate in it. One database available everywhere in the world, but without Venmo or another company maintaining it. That's all a blockchain is. It's the ability to have one database that everyone believes is true, but which no single party maintains or controls. There's no Venmo on top of Bitcoin. And what does that allow you to do? It allows you to do 3 things that we've never been able to do before in the history of mankind. The first thing I already explained to you, which is move financial goods at the speed of the internet. We don't talk about it much, but financial goods are the slowest moving things in the world. Stocks settle in 2 days. My bill pay takes 5 days. Mortgages take 45 days. Bank statements take 30 days. What takes 2 days? You can order something, almost anything from Amazon and get it in 24 hours, but it still takes 2 days to process stock trades. It's incredible. It still takes 5 days for your bill pay to hit your cable account. Crypto, because it's one blockchain, available everywhere in the world, everyone agrees it's true, can move any financial good at the speed that PayPal moves $10 or $20. It can move $1 billion anywhere in the world almost instantaneously. It could settle stock trades almost instantaneously. It could handle mortgage deeds almost instantaneously. But that's actually the least interesting thing that you get once you get this one database. You get 2 other things that are more important that fewer people talk about. Once you move money onto the internet, you can program it like software. If you think about a lot of what the financial services industry does today, what they do is process what I would call if-then statements. Give $1 million to my son, Patrick, when he turns 30. That's a pretty simple statement. That statement today, in order to set up that trust agreement, I have to work with a lawyer and get an agreement, put it in place, etc. Once you have money that exists natively on the internet, you can program it to execute that automatically at almost no cost. And there's a whole world called decentralized finance, which is the fastest growing part of the crypto sector. You're seeing tens of billions of dollars of venture capital investment that is doing things that traditional companies have done, but doing it only with software. There's a decentralized crypto exchange that trades crypto assets that's doing $50 billion of trading volume a month that has no employees, no offices, no entity. It's just a software program. The cover story of The Economist last week was on this concept of programmable money, which is called decentralized finance, and how it's going to rewire the financial ecosystem. But I would argue that's not even the most interesting thing crypto does. So you can move money anywhere in the world. You can program it like software. The third thing is it creates digital property rights for the first time ever. And what do I mean by that? Think about my bank account at Wells Fargo. It's 10 numbers. Anyone could see those 10 numbers. It's literally printed on my check, right? My 8-year-old son, Dash, could push Control-C and Control-V and create 100 copies of my bank account. Fortunately, he wouldn't own it, or else all my money would be spent on Pokemon cards. The reason I own that bank account is because Wells Fargo maintains a database that says Matt owns these 10 numbers. Once you have one database that's available everywhere in the world that everyone agrees is true, but no one single party maintains, you can own a digital good in the same way that you can own a Picasso or a Honus Wagner baseball card or any physical good. You can create digital property rights. You can prove to anyone in the world that I own this digital good without anyone verifying that it's true. People talk about Bitcoin as digital gold. The reason that's called digital gold is the first digital good you can own without anyone blessing it. There were actually multiple attempts to create digital gold before Bitcoin, but you wouldn't trust Mark Zuckerberg to create a database of who owns what digital gold. You know, he would change that, he would issue more digital gold, etc. Once you have one database that's available everywhere that everyone agrees is true, you can have digital property rights. Have anybody seen Christie's doing digital art auctions? Anyone seen that? Someone bought a digital picture for $69 million. Anyone think that's ridiculous? I think it's ridiculous. Okay, it's totally ridiculous. A lot of art is ridiculous. Someone paid $50,000 for a banana duct taped to a wall. I don't think that's beautiful either. But here's the thing, when you see these headlines or when you hear about NFTs, I'm sure you all are hearing about NFTs and it looks ridiculous, and in many aspects it is. That's fine. But what you should ask yourself is, why are we doing digital art auctions now? Why weren't we doing them 20 years ago? NYU has had a digital arts program for 30 years. People were creating digital art in the 1970s. Why is it only today that we're doing digital arts? Why is it only today that kids are collecting digital baseball cards? Kids have been online for years. The reason is, until blockchains, you couldn't have digital property rights. You couldn't own a piece of digital art. You couldn't own a Honus Wagner baseball card online and prove that you were the owner. Crypto creates digital property rights. So people look at slides like this. This is a chart of different assets. These numbers are, or the letters are small, but you can see the colors. The top line is our index, the Bitwise crypto index. The next line is Bitcoin. Then there's oil, S&P 500, international stocks, emerging market stocks, and gold. And this is this year. Crypto is the best performing asset class in the world this year. It's up over 100%. It was the best performing asset class in the world last year. It was up over 300%. It was the best performing asset class in the world in 2019. That's Bitcoin on the top, up 94%. Our index up 51%. This is since Bitwise was founded in 2017. Crypto's up now over 6,000%. Best performing asset class in the world. People talk about crypto as tulip bulbs, but this is that same chart, 2017 to today, up 6,000%. There have been 8 bear markets in crypto. Tulip bubbles went up and went down and never came back. Crypto has always come back. Or here is crypto since 2010. It's up 58 million%. Anyone buy crypto in 2010? I just met someone who was pretty close, but it's done pretty well. People look at this and they wonder, how does this fake internet unicorn money that fell from the sky that I can't go out and buy my Starbucks coffee with, the best performing asset class in the world in the last 1, 3, 5, and 10 years? And the answer is, it's not just a currency, it's a technology. Now I'm 45 years old. I remember when the internet was terrible. I remember looking up websites in books. And if you're old like me, you might remember we used to only be able to do a few things with the internet. I remember all you could do is send people files. There was even a word for it, FTPing. Does anyone remember FTPing people files? Hal remembers. And then throughout the years, since Al Gore created the internet, we figured out all these new ways to do things. Like in 1982, we figured out how to send text over the internet. For the first 11 years, you couldn't send text. 1982, we figured it out. That created email, disrupted the postal service. In 1989, we figured out how to send links over the internet. I'm sure you all have gone to a website and typed in HTTP. That's just a way for the internet to understand how links work. For the first 18 years of the internet, we didn't have links. Once we figured that out, we disrupted all of media and advertising. In 1994, we figured out how to put our credit card information in the internet. I remember the ads. Never put your credit card information in the internet. That was because we didn't know how to hide the numbers. So if you put your credit card information in, you would see all 16 numbers. Amazon was founded in July of 1994. It couldn't have been founded in 1993. In 1995, we figured out how to send voice over the internet. In 2009, we figured out how to send video without it buffering. The story here is, every time we figured out how to do a new thing with the internet, we disrupted a major industry. We disrupted the postal service, we disrupted media and advertising, we disrupted retail, we disrupted voice, we disrupted cable. The right way to interpret what crypto is it's the first time that we've been able to move money on the internet. First time we've been able to program money like stocks. The first time we've ever been able to have digital property rights. It's the first time the internet has gone after money and finance. The reason crypto is the best performing asset class in the world over the last 1, 3, 5, and 10 years. The reason it's the epicenter of venture capital investment today in the US economy. And the reason it's attracting every major Wall Street bank today is it the first time the internet's been able to go after money and finance. And money and finance is the biggest market the internet's ever gone after. Money is a bigger market than cable TV. Money is a bigger market than the voice market. It's a bigger market than the media market. It's the biggest market the internet's ever gone after. And that's why it's pretty exciting that you all have a digital assets portfolio to allocate to in today's market. All right, I got about 10 minutes. I want to teach you two more things, and hopefully I get it done. Why is there more than one crypto asset? A lot of people get confused. We run an index portfolio. I think indexing is a strong anchor for any crypto portfolio, but a lot of people are confused. Why do I need more than one crypto asset? And the reason people are confused about this is the same reason that people go down this rabbit hole of thinking it's tulip bulbs, even though everyone from BlackRock to JP Morgan is making investments into the space. It's that they're thinking of it as a currency. The fact that it's just labeled cryptocurrency and not like cryptocurrency plus technology is the original sin of crypto. If you think of it as a currency, you think Bitcoin is to Ethereum, the second largest crypto asset, as the dollar is to the euro. And then your mind goes, outside of China, the internet is one thing. We only need one currency to rule them all. But that's the wrong analogy. The right analogy is like software companies. These are all great companies. I use 3 of these every day. I use Microsoft for word processing, Slack for internal communications, Salesforce for CRM. I don't use Oracle, but a lot of people do. Everyone accepts that there are lots of software companies in the world, right? Because they're all good at different things. Well, the same thing is true of crypto assets. These are crypto assets. You've probably heard of the top 2, Bitcoin and Ethereum. They're the number 1 and number 2 crypto assets. They're the anchor of the digital portfolio. The other 2 hopefully put their name in their logo. It makes my job easier. I want to explain why Bitcoin and Ethereum exist and why they're both interesting in a way you could explain to your kids. And then we'll talk about why there are other crypto assets out there. Bitcoin was the first crypto asset. For every crypto asset, there's 2 pieces. There's the asset you own, and there's the database that it sits on. So there's the Bitcoin asset and the Bitcoin blockchain. As a piece of software, the Bitcoin blockchain is very rudimentary. Remember, it was the first blockchain. It's kind of like a calculator. In a literal sense, the only thing you can program the Bitcoin blockchain to do is to send Bitcoin or receive Bitcoin or hold Bitcoin or destroy Bitcoin. It can't do much. It can move $1 billion anywhere in the world in 10 minutes. That's pretty cool. But you can't program it like you could program a computer. Ethereum was developed in response to Bitcoin. It looked at Bitcoin and said, wow, it's cool. You can move $1 billion anywhere in the world in 10 minutes. What if we could program this like we could program a website? What if we could program the money to act like a stock exchange, or act like an investment banker, or act like a lending agent at your bank, or indeed to record the transfer of digital art? When someone bought that piece of digital art for $70 million, that was recorded on the Ethereum blockchain. Now you might think, why is Bitcoin more valuable than Ethereum? Being able to do everything, Matt, is better than being able to do some things, but not in the world of cybersecurity. In the world of cybersecurity, being able to do few things means it's less likely to have security flaws or bugs. To make this simple to understand, when the Bitcoin blockchain launched, it was 300 lines of code. When the Ethereum blockchain launched, it was 1 million lines of code. More likely to have a bug in 300 lines of code than 1 million lines of code. People talk about Bitcoin as digital gold because if what you want to do is store wealth in a digital format, if what you want to do is protect yourself from the risk of runaway inflation by having a non-fiat store of wealth, what you care about is that it's extraordinarily secure. And the Bitcoin blockchain, I would argue, is the most secure database in the world. So it's perfect for the digital gold market in the same way that Microsoft is perfect for the word processing market. But if what you want to do is disrupt JP Morgan, if what you want to do is be able to process loans instantaneously instead of over multiple days, if what you want to do is like do what the New York Stock Exchange does, but do it 24/7, 365 and have stocks settle instantaneously, you can't do that on Bitcoin. You need a blockchain that does more. Maybe it's not as secure, not as good for holding your digital gold, but it's good at a bunch of other things. And as you go down the line of the 7,000 crypto assets that you hear pundits on TV make fun of, each one is optimized at something different. Here's a chart I'll show you. You can't see this, so I'll interpret it for you. These are 8 of the 10 assets in our index this year. The bottom asset is an asset called Litecoin. It's up 39%, which is not bad. The top asset, I'm not going to jump, but you can see it, is up 1,400%. It's an asset called Cardano. This is over 9 months. There's a 1,400% difference in returns between the top performing asset in our index and our bottom performing asset. That's a huge difference. Why are there those differences in returns? Because these are all doing different things. The asset at the top is a competitor to Ethereum, that asset where they're recording, where we're transferring digital art or they're building decentralized finance. It's a slicker alternative to that. It's been doing exceptionally well. The asset at the bottom is an alternative to Bitcoin. It's trying to compete with Bitcoin, but be more useful in retail settings. Most people don't want to use those assets, so it's been doing pretty poorly. There are only 8 assets because the 9th asset is up 5,000% and the 10th asset is up 9,000%. Just like different software companies are winning at different rates, different crypto assets are winning at different rates. The reason we index is because it's hard to know which assets will win over the long term, right? I had an AOL account. My parents, I remember viscerally evaluated VHS versus Betamax and went Betamax and regretted that for a while. MySpace had the social networking market locked up. Facebook was 12th to market. It's hard to know how these things evolve. What I have a high degree of confidence in is that the idea of being able to move money instantaneously around the world, being able to program money like software, or being able to have digital property rights are big ideas. I have confidence that this area of the market that's attracting so much venture capital is going to be bigger in the future than it is today. And for this reason, about 90% of my personal crypto wealth is invested in our index product because I think it's the anchor of any portfolio. Last slides, and then I'll open it up for questions. Hal mentioned some of this, but I want to talk a little bit about crypto in a portfolio. You can tell by now I like to correct people's misunderstandings about crypto. This idea that Bitcoin is only a currency is a misunderstanding. This idea that you need only one crypto asset is a misunderstanding. The last misunderstanding is that adding crypto to a portfolio makes your portfolio exceptionally volatile. And Hal showed some of these, but I'll show a few things. Crypto is unique in that it's an alternative asset that has high potential returns, low correlations, and is liquid. Many alternative assets that you invest in have high potential returns and low correlations, but you're locked up for 7 to 10 years. Crypto is unique in that it trades literally 24/7, 365. So it has low correlations to stocks and bonds. Hal showed that. These are more numbers. The correlations tend to be very close to zero. And this is the slide that Hal borrowed as well. This is looking at the impact of a small allocation to crypto from 2014 to 2021. And what's not surprising is that it boosted returns. A 5% allocation to crypto doubled the returns of this portfolio. It gave all the returns that the whole 95% returned. What's surprising to people are these two things. The volatility barely went up of your portfolio, and your maximum drawdown, in other words, the worst experience you had in that portfolio didn't change. And that's surprising to people because crypto was very volatile over this period. There was a year where crypto went down 83%. But there's a concept in academic portfolio development called volatility harvesting, which says that if you hold an asset that zigs while the rest of the market zags, and you're able to rebalance that portfolio, you don't experience as much of that volatility because you end up often buying low and selling high in the space. There's a huge value to it. This is the rolling return chart. Let's see how I'm doing on time. I'm going to end there and answer one question. Hal wants to stay on time. Well, that is true. China effectively banned crypto. There's an old investing adage that says anything that China bans, you should invest in heavily. YouTube, Facebook, the internet. I think they're banning it because crypto is a tool of economic freedom, and they want to be able to surveil where their citizens are spending money. Here in the US, it's absolutely true that regulators are wrestling with how to regulate crypto. That shouldn't be surprising. We're applying rules that were developed in the 30s and 40s to digital assets. It's not surprising that they don't fit perfectly. But I am enough of a optimist in America. And also, we have a lot of people in DC that are talking to folks to believe that we'll exit this with a safe harbor for what this industry can be. The U.S., with the exception of a few years under FDR, have never made it illegal to own gold. I can talk about why they did back then. I don't think they're going to make it illegal to own crypto. They are going to make it fit within the regulatory framework. They're going to apply anti-money laundering laws. They're going to apply know your customer laws. They're going to make sure it's not being used by criminals. And guess what? That's going to unleash a massive bull market in crypto. Because the only thing keeping institutions still kind of on the sidelines is a lack of regulatory clarity. You may have noticed, maybe not, you don't live this 24/7, 365. Crypto is up significantly in the last week. It's up 15 or 20%. The reason it's up 15 or 20% is both Jerome Powell and Gary Gensler, the head of the CFT, the head of the SEC, came out and said, we're not going to ban crypto. The US is going to create a safe harbor for crypto, and I think that will unlock the next major bull market. How? Yeah, absolutely. I love ETFs and I love crypto. So this is at the center of things that I love. If we added in hiking, it would be all my joys. We've been waiting for a crypto ETF for a long time. The first one was filed in 2013. There is a wide expectation that later this year, we will get our first Bitcoin ETF. It will be a futures ETF, a Bitcoin futures ETF. Bitcoin futures trade on the Chicago Mercantile Exchange. That won't be quite as good as direct access to Bitcoin from a return perspective is my belief, but it will be a major signal that regulators are bringing this on side. It will be a major breakthrough, and that could happen as soon as the next 2 weeks. I do think this speaks how to exactly what's going on in Washington with crypto regulation, which is that Congress or the SEC and Congress want to take two paths. They want to crack down on bad things that are happening in the crypto market, any fraud, any bad activity. You see that enforcement action. And then they want to show progress on the other side. And I think we're going to get that progress, I think, as soon as maybe this month. Great. Sure. Yeah. An ETF is an exchange traded fund. It fits under the 1940 Act. It's a traditional traded version of a mutual fund. Our funds are in private placements that aren't equally accessible as an ETF. Our funds can be traded on the OTCQX market, but they can trade to premiums and discounts, which is something that Hal knows a great deal about. But the passage of a Bitcoin ETF will be a major regulatory stamp of approval. Great. You all have been amazing. How is it? Is my time up? I'll be around. Thank you, everybody.
Think so. While we get these presentations all arranged, we want to turn the time over to Tally Ringwood at Taylor Derrick Capital to introduce Rocky and kick off our next presentation that we're also excited about.
My name's Tally Ringwood. I have to introduce myself to then introduce my partner. Rocky started Taylor Derrick Capital with his partner, Mark Taylor, back in 2011. And we are in the real estate space. So Rocky's going to talk about our largest fund, and then he'll talk a little bit more about one of our newer funds that's coming online. So Rocky Derrick.
Thank you. It's good to be here with you guys. That was really interesting to hear from Matt. We're not in quite as innovative of a space, so that was exciting. As Tally mentioned, we're a real estate lender primarily, and we also do real estate investments. So we're in the debt space and the equity space in real estate. And we've been doing this for a little bit over a decade, and we're in the private sector. So we're not, our debt fund, which is called the Mountain West Debt Fund, is structured as a private REIT. So we don't have the volatility of the public stock markets, but we still have what we feel is a very stable underlying asset in real estate. So while they're bringing that up, just tell you a little bit about our, stick over here by the mic. A little bit about our background. So again, we launched in 2011 when real estate markets were recovering. And we really saw, coming out of the last downturn, an overlending crisis. There was just too much money flooded into the market. It was too easy to get a loan, and that created a downturn in real estate. Coming out of that, the pendulum kind of swung the other direction, where banks became extremely overregulated and they were scared of their own shadow. So you had a lot of deals that needed to get financed that the banks no longer were structured to finance very well. So the private markets responded to that, and we're part of that. So we operate in the private real estate lending sector. We're a middle market lender, so we're not lending and competing against the big institutional multi-billion-dollar versions of us. We're lending in the $1 million to $30 million space. We're not lending to end users, to people buying a house. We're lending to home builders and developers and commercial investors that are out operating in the space and delivering product. And so we are a short-term lender. We're focused on doing loans that are roughly 1 year. With extensions, we'll get up to 2 years. But in general, we're not, doing 15 and 20-year loans. There's not enough yield in that, and the banks are really good at that. So we don't try to compete with them on that. On the short-term lending, giving a construction loan to a home builder to build through a subdivision. Banks take a long time to approve those deals, and time is money in real estate, especially in today's market. We've seen real estate in most asset classes, residential in particular, respond very, very well through COVID. And there's a lot of demand there, and therefore to win deals, time matters. And so our group is far faster and more responsive than the traditional lenders, banks and credit unions and life companies and so forth. So that's a competitive advantage we have as a private fund, is that we can act quicker. And our borrowers will pay for that. They will pay a premium in rate if we can help them execute on a transaction that a traditional lender just isn't going to be able to get done in time. And we have a handful of different funds. Our core fund is called the Mountain West Debt Fund, and that fund was launched in 2011. And we have about $350 million in that fund. And that fund, from a strategy standpoint, we like to tell people that we're capital preservation first, yield second fund, which means, we're not going to be your highest performing investment. We're kind of going for base hits and some doubles. And in today's yield-starved environment, it's actually quite strong. Our average returns have been in the low double digits, kind of 11 to 13%. Last year we were down. We netted a 7.5% return to our investors. We sat on the sidelines for a little bit as we waited to see what the markets were going to do in real estate. It was a wait and see approach, and we played it safe and sat on a lot of cash. So that did drag our returns down a bit. But it was a time where no one knew what was up and what was down for a certain period of 2020. And we didn't know what asset classes in real estate, commercial and residential, were going to be negatively or positively affected. So we just sat for about half the year, and obviously not putting that money out in loans, it pulled our return down. But ultimately, it was a time to make sure that we understood what was going on with the markets before we continued to put capital out. Can we put that up here? Systems down. Okay. Well. Real quick about from a transparency standpoint, we are big on transparency. We're registered with the SEC, so we're an SEC registered investment advisor. We use a third-party fund administrator to do all the books for our fund. And we also have a board of advisors that are all vested heavily with us, and they act as a voice for our other investors and a brain trust for ourselves. Covering most of this really. So from a loan to value standpoint, which those of you that are familiar with real estate, if we're going to lend on a $10 million asset, we typically want to be around a 65% loan to value. So we'd have roughly a $6.5 million loan in first position against that asset. So we're not going behind banks. We are basically in place of the bank, and our borrowers are choosing to use us again because we're fast, we're nimble, we're more reliable in a lot of situations than the banks are. And so we're first position, we're secured with a deed of trust. In other states, it's called a mortgage. And so we're secured with a deed of trust on that asset. And again, we're able to charge a higher rate than the banks because of our flexibility and our speed. And the protection of the real estate is the underlying collateral. And our portfolio at the end of Q2 was sitting just below a 64% loan to value. We had 81 loans in the portfolio at the end of Q2. And so it's good diversity. You're not putting all of your investment in one single loan on one single asset in one market. We are not a national lender. We focus on the Mountain West states. So we stick to what we know. And we're a big believer in the Mountain West states. Those of you, some of you are here from Utah, some of you are from surrounding states, but the demographics in the Mountain West states tend to they tend to be stronger than the country as a whole in regards to population growth, in regards to job growth. Utah has the lowest unemployment rate in the country right now. And so we're very bullish on what that translates into real estate demand. And ultimately, that also helps us just to, real estate's local. You don't want to end up on the wrong side of the tracks and not know what you don't know about a particular submarket. And it helps us just to make better investment decisions if we stick to the states we know. So Utah is our core market. About 40% of our portfolios throughout Utah. And then Colorado is about 20 to 25% of our market. And then the surrounding Mountain West states, Arizona, Nevada, Idaho. And we do have some of our loans in Southern California. Got some pretty pictures to show you the assets we lend on. You'll just have to imagine them. What I will say about that is, some people, you've got a pretty big gap between where the banks stop on their lending parameters and their pricing, and then what some of you have maybe heard about hard money lenders. And so, on the bank side, extremely conservative. It's your cheapest capital, but it is slow and sometimes difficult to work with the red tape that they have and the box that they need to live in from a regulatory standpoint. On the hard money lending side, it's kind of the wild, wild west, sometimes called a loan to own group that's more aggressive, and the rates are a lot higher. So there's a big gap between those two ends of the real estate lending spectrum. And we live in there. It's a space that is competitive, but we can generate really strong yields. And we've worked hard to create a reputation with our borrower base that we've proven to be a dependable source of capital. A lot of the private lenders in the space are more transaction oriented, meaning they solve a problem for a borrower. They help them get a deal done, but it was just that. It was a deal. And we actually have 80% of our current borrowers are repeat borrowers. So we've been able to establish long-term relationships. It works for them. It works for us. They're willing to pay a higher rate because of our ability to help them execute. And if they only need the money for 12 months because they're building homes and they're paying us off with their buyers, they can afford to pay a higher rate for 12 months. Again, we're not trying to lend to them for 20 years. And so that ability to execute and move fast with them becomes a valuable piece of their ability to succeed. And those relationships are a big deal for us. If we're doing loan 5, 6, or 7, it's a lot less risky than loan number 1. And we've got a lot of borrowers that have been with us for our full life of the fund, 10 years. And so that 80% of the portfolio made up of repeat borrowers is a big focus of ours. And then from a fund structure standpoint, just ad libbing a little bit, we're going all over the place. So I apologize, we don't have the presentation. But from a fund structure standpoint, most funds are structured as an 80-20 fund with a 2% management fee. You guys are probably familiar with that with some of the other alternative private funds you've invested in. We left a little bit more upside for investors. It's 2% management fee, but 85-15 split. And we also, in our sector, in our space, it's common to charge origination fees, just like a bank charges origination fee. We're going to charge origination fees in the private space. We're usually charging 2 or 3 points for origination. Sometimes we charge 0 and charge a higher rate. We have flexibility for what works best for the borrower. But my point is those origination fees on a 6-month loan or a 9-month loan or a 12-month loan or an 18-month loan are actually a big piece of the annual yield. And a lot of the groups in the sector will just pocket those fees as to go to the general partner. We share anything we charge the borrower, the origination fees, extension fees, legal fees to prepare the loan documents, that all goes into our 85-15 split. And historically, that's actually lifted our investors' yields by about 25%. So it is significant. So, as just a little bit of a recap on the debt fund, from a risk reward standpoint, debt isn't as sexy, it isn't exciting as equity, but it is more consistent. And with being in a first position debt spot on these real estate assets in markets we know and markets that we like, we feel that we're well protected for the downside. Right? Our borrowers are taking the bigger risk. They also get the bigger upside, but our borrowers are taking the bigger risk in the sense that if the market corrects by 10%, they're going to take that on the chin. That's not going to protrude down into our loan position. Oh, hallelujah. Now that my time's up, we've got our presentation ready to roll. We can stop right, go back one. Yeah, I'll run through a couple things here. So thanks, guys. You're the man, Ammon. I'm gonna push through most of this debt fund stuff so that we can jump to a new fund. But you can see a breakdown of the diversity of assets that we have on the far side: townhomes, condominiums, single family homes, residential lots, trending into some commercial. About 2/3 of our portfolio is in residential. We're bullish on residential. We feel like there's a long runway of demand in residential, and there's very limited supply of residential, both for rent and for sell product. There's real demand. In the last real estate downturn, it became a very speculative market, and it got oversupplied. The music stopped, and there weren't real end users waiting for homes and for apartments. Today, it's the opposite. In Utah, we have, depends on the month, but we're just sitting at like a 6 to 7 to 8 day supply. We just have no supply. Colorado's similar, Idaho's similar, Arizona's similar. So the markets that we're active in have very limited supply, which keeps us bullish on what we're doing. Here's an example of some of the assets on the residential side that we've recently lent on: townhomes, condominiums, single family homes. Here's an example of a few of the commercial assets we've recently lent on: apartments, triple net lease deals like 7-Elevens, Jiffy Lubes, other concepts like that, industrial, some office, some retail. When we do lend on retail, we like to focus on assets that we call Amazon proof. You can't get your oil changed through Amazon, but you can do a lot of other things that are disrupting retail. So we try to focus on those Amazon proof assets. I mentioned the fund structure. It's a $250,000 minimum. Investors do need to meet the qualified client requirement, and there is a 2-year lockup. So investors do need to be comfortable coming in and parking their money there for at least 2 years. And after the lockup, we do redemptions that historically we've been able to meet inside of 60 days. We did lock it down for most of the year last year, just to make sure that we didn't have any liquidity crunches when people were kind of getting emotional during COVID. But outside of that, that was the only timeline in our 10 years that we did not service redemptions. There's a lot of numbers on this page. Just wanted to show what our historical returns have been. You can see on the far navy blue column, we've kind of ranged from 10 to 17%. The 17% days are long in the rearview mirror when we had no competition. But it is a competitive sector today, and we've been able to average kind of 11 to 13%. Last year was a down year. I mentioned earlier that we decided to sit on the sidelines for a little bit and make sure we understood what we were and weren't comfortable with our investors' capital, and therefore we lost some income and we lost some yield by doing that. But again, capital preservation first, yield second. That's our mantra. We're not going to step on the gas when we feel like we need to pump the brakes. So I'm going to pause really quick. Thanks for being patient with me when I didn't have my deck. But do you have any questions on our debt fund? I'm going to transition into talking about manufactured housing and some opportunities that we have in that sector. Yes, sir. You know, it's free market. And so competition will go to sectors that have real demand. And the good news is there's really strong demand in this space. A slide I didn't put in here is the deals that we see. We've spent the last 10 years building a great reputation and over 800 mortgage brokers that feed us deals. So we see 2 to 3 new deals a day. And last year we saw over $8 billion of loan requests, and we only funded 329 million. So as we track this, we typically average about 5% of what we see we actually approve and fund. And so the deal flow justifies us being a multi-billion-dollar fund. But as our Soltis crew knows, we're more of a slow growth approach. We just don't want to get too big too fast. And this is not as scalable of a model as some, as digital assets and some of these other spaces where you're investing in a strategy, and whether you're investing $1 billion or, $100 million, it's going in the same strategy. We need individual deals that fit our targeted market and our deal size. And so growth for us, we've kind of gone a slow growth route, although we're still, in a good spot size-wise where we can serve our clients' needs. But we have far more deals than we have capital. Yes. Yes. We can get a deal done on average, it's 3 to 4 weeks. And banks are kind of like 2 to 3 months if you're lucky. And they kind of move the goalposts because there's multiple credit committees. And myself and one of my partners that heads up underwriting for us, we're talking to the borrowers, we're underwriting the deals, we're doing the site visits, we're looking at their financials. So they're talking to the decision makers, and we make those decisions in real time. And that's really valuable to our borrowers. And with repeat borrowers, we've been able to help them close deals in less than 2 weeks, which again is super valuable to them. Yes. We actually aren't tied directly to those rates. So actually rising interest rates probably helps us. Historically, private lending's kind of been, if you're a construction loan, we're kind of in the 10 to 11% interest rate range. If it's a bridge loan where we're not taking construction risk, we're kind of in the 6 to 8% range. And it's really driven by competition. We don't borrow money to turn around and lend it back out. It's our investors' money. So it does have an effect as our borrowers are comparing, do I go the bank route and deal with the headache or do I go with Taylor Derrick Capital, one of their competitors? Like I have some more surety of close. I'm going to pay a premium for that. It's really driven more by our competition. So it is indirectly affected, and honestly, rising interest rates probably helps us because it lessens the spread from them borrowing from us versus a bank. Good questions. Let's jump into mobile since time's short and I don't want to disrupt the entire schedule. So manufactured housing. This is a space that we've been investing in for the last few years, and I just want to run through some fundamentals of why we like it, and then I'll skip some slides and just get to the point. But manufactured housing, mobile homes, they are a solution for the affordable housing crisis that we have today, right? Affordability is crazy, especially if you're a blue collar worker. Your options for housing are very limited. The average home in today's market across the country new home is $421,000. The average new manufactured home is $100,000. There's 22 million people in this country that live in manufactured housing. There's definitely a stigma that can, be poor in regards to how people view manufactured housing or mobile home communities. As we've learned more about the sector and the space, and we've learned about the drivers and the demand, we've become very bullish on it. And, Christy and Matt and some others have actually toured some of our communities. And I will say there's real pride of ownership in these communities. What you have going on is it's a space that's very fragmented. It's a lot of one-off owners, mom, pop owners that a lot of times are undercapitalized. Maybe it's a second or third generation property that gets a lot of deferred maintenance. And you'll see that as a home leaves, they don't have the capital to buy a new home and bring it in. So you do have a lot of broken parks, broken communities. And what we've focused on with our operating partner is going into these communities that might be 50% vacant. They have a lot of deferred maintenance, and quite frankly, they don't look great, and they aren't a great quality of life for the residents that are there. We can buy those, at an underperforming price because they're not kicking off tremendous NOI because of their high vacancy. And we go in and we repave the roads, we re-landscape, we fix up the clubhouse, we fix the pool, we put in a tot lot, and we start to turn, put the money back into these communities that haven't been invested in years. And then on those vacant pads, the old school mobile home program is to create a sales program and sell people a mobile home. And, the lending options on those are not great. They're short amortization schedules, they're high rates. It's a big, painful payment for these residents. We actually are buying mobile homes in bulk. We can buy those, to the tune of $40,000 to $50,000 to $60,000, depending on the unit, and we're renting those. So we're creating, basically apartment communities out of mobile and rent. These are new 3-bedroom, 2-bath units that the community as a whole has been invested in and upgraded. And rents vary by market. We're talking $700 to $800, $850 rent for a 3-bedroom, 2-bath. Equivalent Class C apartments in these submarkets, which are not a pretty place to live, are typically $200 higher. So we're typically providing additional square footage, a yard, you're not sharing a wall. And as we upgrade these communities, it's actually a really, really nice quality of life. So we feel like there's a strong social impact in what we're doing and a great economic and investment opportunity. A couple of cool things too, just we're running low on time. It's interesting, but mobile manufactured housing, mobile homes, they actually have very sticky tenants. You can see that the average turnover in multifamily is about 50% year over year. And you can see in the blue manufactured housing, about 93% of tenants renew and stay. If you look at the next chart for CapEx, that's capital expenditures. According to the income that's being produced, it runs at about 14% for apartments, multifamily, and roughly 6% for mobile homes. So they cost less to maintain as long as you don't get behind on maintaining them. And then the other one I want to point out with the 2 red boxes, they're recession proof. Okay, this is the bottom of the pyramid for affordable housing. So even if you have people that can't afford, you have people coming from the step up or 2 steps ups that they have to downgrade their housing budget. And so if you look historically how manufactured housing has performed, you can see the gold line has been very consistent. And you see what happened to apartment rents in the last 2 recessions. They dropped, right? But those people need to go somewhere else that they can afford, and mobile home captures the bottom of that affordability segment. And when you can run them right and invest in them and keep them looking the way that they should look, it really becomes an incredible solution to affordable housing. And so there's upward rent trends that we anticipate will continue in this sector and lower operating costs as it shows. The last thing I'll mention in this last one is it's static in regards to new supply coming on. I'd imagine none of you would be overly excited if the neighboring undeveloped piece of land in your neighborhood was proposed to be a mobile home community. You wouldn't. You'd show up and you'd fight it, and that's what happens nationally. And so there are very limited amount of new mobile home communities that get approved today. The legislature doesn't really allow for it. You can see from a product standpoint, the amount of new mobile homes coming online on a percentage basis compared to multifamily, industrial office, strip centers, malls. It's basically static supply with growing demand. And, you know, it's just, it's good math, right? So you like that. You fast forward 5 years, fast forward 10 years, that bodes well for rents. That bodes well for resale prices. We're running low on time, but in short, our operating partner is actually one of the top 10 owner operators in the country. They own over 33,000 pads, close to 200 communities. They're really good at what they do. They have one group that focuses on the value add play, where we do find a park that's broken. You know, it's 50% occupied, 60% occupied. They're really good at coming in, investing in that park, figuring out what they need to do, bringing in the new mobile homes, and taking it from, you know, our first investment in 24 communities. The average portfolio occupancy in 2019, when we bought those communities, was 48%. Today, it's 85%. They look completely different. Your Soltis advisors can share some videos that we can show you some before and after, so you can see, you know, the reality of what those look like when we bought them and what they look like today. And they're kicking off great stable cash flow now. We also just got a refinance facility done with Fannie Mae at 3.3% locked debt, and we were able to pull out about 30% of our investors' initial investment, and that'll be hitting their accounts later this month. And that's at about the 2.5-year mark from our initial investment in that deal. So there will be liquidity options on our new fund, where we anticipate being able to get cash back out once we stabilize those assets and can get debt, and that's tax-free. You know, refinance proceeds are tax-free, which we all like. And the plan for this new fund is kind of a 5 to 7 year play. And we will plan on quarterly distributions that'll commence kind of at the 18 to 24 month mark. And a couple other things that I want to show here. From a tax standpoint, apartments, those of you that have invested in real estate, you understand the benefit of depreciating an asset. So an apartment community, if you invest in an apartment community, the depreciable life of an apartment community is 29.5 years. Okay, so you get to depreciate your investment in that deal over 20. So you get to hide's the wrong word, but you essentially get to hide part of your taxable income against that depreciation. In mobile homes, these thousands of new mobile homes we're buying and putting on those vacant pads, we get to depreciate that over a 5-year life. So that really helps during that 5 to 7 year hold period. We have tremendous depreciation that passes through to our investors and helps cover a lot of that taxable income. So got a little bit disrupted at the start, so I apologize about the flow and jumping around. But in short, we are going to launch a new fund with our same operating partner that we plan on rolling out later this year. We anticipate that it'll be ready for investments December 1st. We're forecasting IRRs in kind of the 15 to 17% range net to our LPs, and a cash on cash quarterly distribution that'll be in the 5 to 8% range. And it'll take about 18 to 24 months to get to that point as we buy and invest in the assets and stabilize. And the last thing I'll say, that this new portfolio isn't all going to be value add. About a third of the portfolio, we're going to buy 4 and 5 star parks that are kind of more very consistent. Some of them are 100% occupied, coupon clippers. It helps on the exit with some of these large institutional groups to have some of those sprinkled into the portfolio, help with our exit price. So with that, do you have questions about our current manufactured housing fund, which some of you invested in? We call it our Equity Fund 5, or this new mobile fund that we're rolling out? Yes. Good question. So I kind of skipped over it. The short answer is no. The first fund we did, Equity Fund 5, that was an opportunity zone fund, and it had some great tax advantages to roll capital gains into it. This fund will not be an op zone fund, which there's some pros and cons to that. The pro is that we don't have to hold for 10 years. So if we have the option to exit at a strong profit in 3 or 4 or 5 years, we can do that. But we don't have the tax advantages that come with the op zone. And at 1031, you have to hold the ownership on your own. You can't come into a fund where you're a limited partner in the fund. Any other questions? All right, well, thanks for being paid. Oh, yes. So mobile, we don't have that same tight Mountain West footprint that we have in the debt fund. Mobile is actually a lot more common in the Southeast and the Midwest than it is here in the West. And so it is a national footprint. Our operating partner has boots on the ground in every state that they operate in. Yes. We're still working that out with Soltis. It'll be probably either 250,000 or 350,000 to be determined. It'll be a qualified client requirement for the investors there. And also not liquid, but we will have some liquidity events with refinances. And then ultimately the sale of the portfolio. Yes. Yes. Yeah. So in regards to our other equity funds that have other assets, yes, but our debt fund, it's better than ordinary income because we are structured as a REIT. So you get the 20% deduct. It drops your federal tax rate if you're in the highest bracket from 37 to 29 and change. But what you're talking about is more specific to our equity funds. And the short answer is yes, where it's applicable. Okay. Thank you. If you have any questions, my partner Tally will be here. I'm around.
Wayne, just that whole experience. And then last night, I didn't know if I wasn't in on something. I don't know if you noticed, but I was sitting there and Lexi Walker started kind of singing like directly to me. And I thought, Kim, am I supposed to be in on this? I didn't know how to react. And all of a sudden, this girl starts standing in front of you and she has some pipes, doesn't she? She can really sing. And so just a lot of fun. And with Kurt Bester, and the food was great. Just wonderful environment. But, it's also very serious. And today is about education. We appreciate so much those that have invested with Griffin Capital. So you may not have heard of us before you were introduced from Soltis. So it's my privilege to kind of introduce a little bit about the firm and then ultimately introduce Eric Kaplan, who's the president of our private equity division. So at Griffin Capital, I'm going to kind of fast forward through a couple of disclosure slides and then kind of set the table for what we're going to discuss today. Eric's going to go in greater detail on our qualified opportunities zone fund investments. Now we've had two. We've raised approximately around 500 million on our first fund. We closed that. They have a finite life, and so there's kind of a timing of those. And those are really under the exclusive direction of Eric and his leadership in building those portfolios. We're subsequently raising capital on Qualified Opportunity Zone Fund number 2. And we're getting to the tail end. In fact, we've probably got about as much capital as we can take in that particular fund, because as Eric will go into detail of the development of the multifamily complexes, there's some timing and logistics to that. We are anticipating introducing a Qualified Opportunity Zone Fund 3. And I say anticipating because that's really going to be up to Eric and his team in making sure that there's quality investment opportunities, and he'll speak to that. We're going to make the case for multifamily. Our Qualified Opportunity Zone funds focus on multifamily development. For those that are in St. George, how many of you are from St. George? I'm from St. George here. So, when you go over across the bridge at Lynn's over in Washington Fields, you've seen the new construction of Zwick. Zwick Construction is building a multifamily or apartment complex. It's right there, right next to Lynn's. It's a beautiful complex, first-rate construction, great location. And you imagine they'll probably charge quite a bit of rent there, right? Because there's just no housing in St. George. When you think of that, you can kind of think of what we're doing nationwide in some of the strongest markets with some of the highest quality partners. And that might be something you can relate to as you drive by there. And Eric will go into detail. But in addition to our Qualified Opportunity Zone funds, let me just share with you a little bit about what we also do at Griffin Capital. For the purposes of this meeting, we'll introduce another division of our real estate, which is we believe in investing in institutional quality real estate. And Clark did a great job in his presentation. He had a couple of quotes. And his second quote was talking about a Henry Ford quote. And so Henry Ford, of course, founded Ford. And we all know about Ford. I drive a Ford truck. I love it. But there are thousands of retirees that work for Ford, right? Thousands of pension holders. And so they have an obligation to those pension holders. And what do those pension holders want? They want income, right? They want to know that there's a dependable paycheck coming every month for the rest of their retirement and that they're going to be able to live the lifestyle that they anticipate. And Ford invests in commercial real estate for part of that pension. You may not know that, but that's what they do. They diversify their portfolio and they find the highest quality commercial real estate that they can find with the proper institutional advisors to manage that real estate. And it enables them to have a predictable outcome, which is to drive income. And so one of our funds that is much more like a mutual fund has lower minimums. It's very easy from a tax standpoint. It's a 1099. About 70% of the income on that 1099 is tax favored, but it's a stabilized portfolio. It's called an interval fund. And the name of our particular fund is the Griffin Institutional Access Real Estate Fund. It's a long name. And we put a long name on it because it really describes what in fact we're doing, which is within that fund, we're actually investing side by side with the Ford pension or the Coca-Cola pension, with the highest quality institutional asset managers in commercial real estate. Right now, we like multifamily and we're overweighted to multifamily, but we really invest in the four commercial asset classes in that fund. Now, there's a lot of mechanics behind it, but the thing that I would say to you is that what's the purpose of that fund? It's to diversify from the equities and bond market. You saw the model portfolios that Clark talked about, which is you want to have a broad diversified portfolio that produces different results under different circumstances. But overall, it dampens the volatility of the portfolio and it ultimately gets you to achieve your goals, whether it's growth and income. For our portfolios, they'd probably be in your growth and in portfolio, your income portfolios, your more conservative portfolios. And so we are just one of the tools at the disposal of Soltis if it's appropriate for your portfolio to be a small piece of the portfolio. And the purpose of it is to make sure that we have a very predictable income stream for you as investors. As a diversification tool from right now, we see the biggest risk in fixed income. Now we could talk a lot about that and I won't do that, but with low rates, as rates rise and with inflation, there's a potential risk for one part of the portfolio that almost everybody owns, which is bonds. And we know that experts at Soltis understand that. And so that's why they look at firms like Griffin to solve that problem. So with that, we just appreciate the opportunity to be here. Of course, if there's anything that Brian or myself can answer, or certainly Eric, happy to do so. We'll be here through the rest of the conference. And it's just really a privilege now to introduce Eric Kaplan. Eric Kaplan has a strong academic background. He's graduated from Clemson, huge football fan. So if you want to talk about Dabo Swinney, you can talk to him about that. He's also a UCLA grad, as a master's from UCLA. But he is, they talked about having experts in the room today to talk to you. He's an absolute expert when it comes to real estate. Worked with some of the largest institutional commercial real estate firms and has just done a dynamite job here at Griffin. So Eric, thanks for being here.
Great, thanks, Corey. Appreciate the introduction, and I want to thank Kim and the entire Soltis team for allowing us to speak to you today. They've been a great partner, and we truly appreciate the support that they've given to Griffin. But before I talk about real estate, multifamily, and the opportunity zones, I do want to spend a little bit of time on Griffin. As you can see, we were founded in 1995, and we've sponsored about $20 billion worth of real estate investments over that time period. But what's really important, if you look at the table, is the bottom right-hand corner, and it's the $300 million. So as a firm, we've invested over $300 million of our own capital into all the different real estate investment strategies that we employ. So as we like to say, we're an investor first and a fund sponsor second. So we're really proud of the fact that we've got $300 million invested, including multi-millions of dollars in our opportunity zone funds that I'll touch on in a moment. So what I'd like to cover in the short period of time that we have is, one, what is the opportunity zone legislation and what are the benefits that come along with it? Two, what asset class are we investing in? And Corey touched on multifamily. So why did we select multifamily? And then third, how are we executing on that strategy in order to get what we believe are terrific risk-adjusted returns? So I'm going to spend a little bit of time on the legislation. The legislation was passed in December 2017 as part of the Invest in Opportunities, as part of the Tax and Job Cuts Act. And it's within subchapter Z of the legislation. And the goal was really to drive investment into lower income areas through the use of capital gains. And there are three primary benefits to the legislation. So I'll touch on all three of those again before talking about what strategy we're employing and how we execute on that strategy. Again, it's money that's driven through the sale of an asset that generates a capital gain. And a capital gain can be anything. It can be the sale of a piece of real estate. It could be a coin collection. It could be a stock. It could be a bond, anything that qualifies for a capital gain, and whether it's short or long term, qualifies for the opportunity zone legislation. And the other interesting part of this is you just are investing the gain. So for example, if you bought a stock at $100, you sold it for $300, generating a $200 capital gain, you don't have to invest the $100 your basis. So it also provides liquidity and diversification. So you can invest all or part of that $200 capital gain. So it's a very powerful tool when you're looking to diversify your overall portfolio. And there are really three benefits to the legislation. And we refer to them as DRE, which is deferral, reduction, and elimination. So you sell, let's just use a stock as an example. You go ahead and you sell your stock that generates a capital gain. From the time you sell that stock, you have 180 days in which to invest that capital gain. So you go ahead, you decide to invest in an opportunity zone fund, ours or a similar fund. You then typically, if you sold something, you'd have to pay tax in that year. The deferral advantage is you don't pay taxes on that initial capital gain until 2026, payable in 2027. So you get 5 years of deferral, which is a nice benefit, but really isn't driving the bus. The second benefit you have, which we call R, or reduction, is you get a 10% basis step up in that initial capital gain if you hold it for a period of 5 years. That benefit actually goes away at the end of 2021. So if you are interested in investing, you've got a few months left in order to gain that benefit. So just by way of example, if you had a $100 gain, typically you would pay tax on the full $100 gain. With the 10% basis step up, you only pay tax on $90 of your $100 gain. So again, that's a nice benefit. That's not really what's driving the power of this legislation that was created. The real power is the elimination of the capital gain on the money that you invest in a qualified opportunity zone fund. So if you hold your investment for a period of 10 years, that is the life of our fund, any gain that you make on that investment is tax-free. So again, just use an example, you invest $100 in a qualified opportunity zone fund. At the end of 10 years, that $100 is worth $400. So you've had a $300 capital gain. That $300 is tax-free. So, in my lifetime, I'm 58, been doing this for, 35 years. That is the most powerful, tax legislation that I've seen during my lifetime. So again, very, very powerful. We think it can be a terrific part of your portfolio as you look at potential capital gain appreciation in your portfolios in a way to utilize op zone funds in the legislation that's been created. And I'll just take a moment and talk about one of the things we've created within our fund is the ability to pay those taxes when they come due in 2026, 2027. We wanted to create a self-contained mechanism where we would provide you with the liquidity to pay those taxes. So as I mentioned, and Corey mentioned, we're investing in multifamily. Our program is we'll develop the assets, we'll lease them up, and then at that point we would refinance them and use those refinance proceeds to distribute to you to allow those gains to pay your capital gains tax that's due in 2026. So it's really a self-contained mechanism. The question is often asked is, the legislation was to to drive investment into low-income areas. How does the government define what a low-income area is? There are really two tests. It's a poverty rate of at least 20%, or the median household income does not exceed 80% of the MSA's average median household income. All the data is based on the 2010 census tract or census with some updates in 2013 and 2014. So I can tell you in the markets that we're investing in, those areas have seen terrific economic growth, a lot of gentrification in a lot of those areas. So, we're investing in markets like Austin, Phoenix, Nashville, Denver. And I can tell you these micro locations look significantly different than they did, 8, 9, 10 years ago. Then the next question that people ask is, okay, I invest in the op zone. You've talked to me about the benefits. What does it really mean, and how much extra cash flow and income will I derive if I do choose to invest in an opportunity zone fund? So this is a hypothetical example. In our fund, we're projecting to generate over the 10-year holding period, net returns to our investors of 8 to 10%. So just using 9% as the example here, if you have two choices, you can invest in a non-QOF and get your 9%, or you could invest in an op zone fund and achieve the same 9% return. And if you go to the bottom right-hand corner, what you'll see here, and I apologize for those that I'm blocking the screen, you'll see at the end of the 10-year holding period, you're going to generate 25% more income. So on $1 million investment, you would pick up an additional over $400,000 during the time, or about 400 basis points or 4% in your return. So again, that's just the benefit of a simple example of the benefit you get from this legislation. So it's very, very powerful. So on one side of the street, you have a non-op zone property. On the other side of the street, you have an op zone property, and you would pick up 25% more profits just by investing in the op zone. I'm not going to go into a lot of detail here. This is federal legislation. Each state's a little bit different about whether they conform to the federal tax code. So it's really state by state. Again, I'm not going to go into a lot of detail. Speak to your Soltis advisor based on where you live. There'll be slightly different tax treatment. And then, as Corey mentioned, and I've touched on, if you look at Griffin, we invest in office, we invest in industrial, we invest in healthcare, as well as multifamily. So the question became, we've got this expertise in these different asset classes. What fits best? Which asset class fits best for what investment strategy we're going to employ in the opportunity zone fund space? And we quickly landed on multifamily. And we did it for a number of reasons. Number one, people need a place to live. So it's a necessity-based investment. And if you look at what happened during the pandemic, office, hospitality, and retail all suffered greatly, naturally, given what happened, while multifamily held up extraordinarily well. So it's, in essence, it's not recession proof, but it is definitely recession resistant. Then at the end of the day, it's all about investing in proper risk-adjusted asset classes. So this is a table. It's from 1 to 10-year holding periods. We utilize here what is called the Sharpe ratio, which simply is a measure of risk reward. And what this table tells you is when you compare apartments to industrial, office, retail, and hospitality on a risk-adjusted basis, again, over 1 to 10-year holding periods, multifamily has significantly outperformed those other asset classes. So you get the best returns with the least amount of risk. So it's really a terrific combination of the two. And as I mentioned, during the pandemic, multifamily held up really well. This is just one example. These are collections looking at pre-pandemic and then during the pandemic collections on multifamily space over periods of time. So for example, in March of 2020, on a national basis, 97% of renters paid their rent. on time. And in March of 2021, so as you were in the heart of the pandemic, 96% of the folks paid their rent. So it's held up, multifamily's held up extraordinarily well. I mean, you look at, again, retail or hotels, and unfortunately, they were hugely affected. The good news is they're all starting to come out and start to do better, but multifamily really held up well. Again, it's all about risk and return and preservation of capital, number one, and then number two, hopefully we can achieve strong returns. I'm going to touch on this slide for a second. If you own an office building, for example, you may have 3 to 5 tenants in your office building. If 1 or 2 of those tenants move out, you're going to have a big diminution and a big hit to your cash flow. With apartments, generally they stay anywhere in the 93 to 97% occupancy range. So if you lose a few tenants, you can bring new tenants in. So there's just much more stability in owning an apartment building than owning, again, an office building where your tenants can leave, or an industrial building where your tenants may leave as well. And then with apartment rents, you can adjust to the market quickly. Typically, people are signing 12-year leases. So if you're in a strong environment, you can raise your rents. And I can tell you just anecdotally, in our portfolio, we're raising rents 8 to 10% in our properties across the country. The apartment market has just been that strong. It performed fine during the pandemic. And now as we get to the backside, hopefully get to the backside of the pandemic, we'll do even better. But being able to get 8 to 10% rent bumps, the portfolios perform well. I can tell you we don't project those kind of rent increases when we underwrite our assets. One of the other positive benefits that's been happening lately in the housing is everybody sees multifamily home or single family home pricing going up. Just by way of example, a statistic came out today. Home prices have jumped 23% nationwide over the past year. So homes, even though we're in a low interest rate environment and incomes are increasing, it's made homes unaffordable for a lot of people. So as a result, that's created a lot of positive tailwinds for the multifamily market. And then, these are 10-year investments. So we really look at what are the demographic trends that are happening. So we want to make sure and feel good that multifamily will be as strong, over the next 10 to 12 years as it is today. And you've got some terrific, again, demographic tailwinds behind you. What's really happening is you've got the Gen Zs and the millennials. They continue to rent. They rent for a number of reasons. Student debt, for example, we read about student debt every day and what a problem that is. People want the flexibility to move, whether it's for a job, to move across town, to be closer to their friends. So we call that locational flexibility. So that's typically on the younger end of the spectrum. They may have problems with a down payment and saving, particularly with the student debt. So on the younger end of the spectrum, terrific demand for rental properties. And then on the other end of the spectrum, it's the baby boomers. I'm a perfect example. I've got 3 children. My youngest one just went off to college. We have a 4-bedroom house. I don't really need a 4-bedroom house. So eventually we're going to downsize. We may rent, we may buy something else, but we're seeing a lot of demand from the boomers as their children move out for a different type of housing. Again, it's a downsized, smaller house, condo, or an apartment building. So really good secular trends that portend well for the multifamily space. I'm now going to talk a minute, and I don't know, how are we doing for time, Corey? Okay, great. So again, when we looked at the Opportunity Zone legislation, originally we were just going to invest our own capital and create our own Opportunity Zone funds. As Corey mentioned, we're now closing out our second Opportunity Zone fund. We chose multifamily. We believe it is the best risk-adjusted asset class to be in, given the term of the investment. And then the question is, how do we execute on the strategy? And the mantra within Griffin is always, whatever we do, let's do it with best-in-class partners. So the first thing we did is we took the relationships that I have and others have in the firm, and we reached out to some of the biggest, best institutional apartment developers in the country. So these are groups that will typically invest money, pension fund money, for example, that Corey mentioned earlier. So it could be the state of Wisconsin pension fund, the state of Utah pension fund, the Ford pension fund. So they're entrusting their capital to these developers. We're doing the same thing, because the last thing we want to do with our money, as I mentioned, we're an investor as well as yours, is take partner risk. Multifamily development, it's construction, it's leasing, it's property management. It takes a lot of skill sets. So number one, we want to make sure that we have the best partners. So between our two funds, we've got a dozen groups that we invest with. They're household names. If you're familiar with apartment development, it's Greystar, who's the largest apartment developer in the country, Alliance, Mill Creek Residential, all again, in the top 5–10% developers in the country. We also will only invest with them in markets that they've developed in before. We don't want to be pioneers and get shot in the back by going with a group into a market that they don't know. So we're very, very focused on partner selection. The next thing that we focus on is, where do we invest? What markets do we want to invest in? And again, as Wayne Gretzky says, you want to look at where the puck is going, not where the puck is right now. So we are very, very focused on high job growth, high population growth markets with a high quality of living, educated population. So if you look at the composition of our portfolio, we're heavily weighted in markets like Austin, Nashville, Phoenix, Denver, the DC area. Again, where people are moving to, Tampa, Florida. And there was an interesting statistic that the Wall Street Journal came out with, and it was, what are the top 3 markets for population in migration during the pandemic? And they happen to be Phoenix, Nashville, and Austin, again, where we're investing. So I think I think the pandemic has served as a catalyst for the movement out of the more expensive, highly populated markets like New York, Boston, San Francisco. And Austin's a great example. You may have seen yesterday, Elon Musk announced that he's moving Tesla's headquarters to Austin. He's under construction now on his gigafactory that is over $1 billion and will be over 10,000 jobs. SpaceX is moving to Texas as well. Apple, again, just by way of example, is under construction on a second facility in Austin. And when they're done, they'll be they'll be the largest private employer in all of Austin. So for folks who are in Boston or the Silicon Valley, it's very expensive. They can't buy houses. To be able to move down to Austin, which is a great quality of life, no state income tax, it's just a terrific choice for them. Nashville's another good anecdote. It used to be the country music capital and what we would refer to as the eds and meds market. But if you look at over the past few years, Amazon is under construction on a property. They're moving over 5,000 jobs. Alliance Bernstein, the financial services firm, moved out of New York to Nashville. Bridgestone Tire, another company I'm sure you're familiar with, they moved their headquarters to Nashville. So you've just got this great momentum into these real Sun Belt markets. So we're really, again, just trying to follow the puck. And when people ask me, Eric, are you going to achieve the returns that you're projecting? The honest answer is, I don't know. 10 years is a long time, but I feel highly confident that, the markets we're investing in and then the locations within those markets, those assets will be worth significantly more 10 years from now than they are today. Yeah, sure. So these, in order to qualify for the Opportunity Zone benefits, you have to develop. So we're building, Class A apartment communities with, all the bells and whistles. So the clubhouse, the fitness center, the co-working rooms, the dog park, the dog spa. But what we're not doing is building high rises. And we're building more what you would call suburban garden style apartments or, wrap product or a wrap project. And the reason we do that is I sort of call it the pyramid of leasing, just to give you an anecdote. If you're building a high rise, it costs the most to build and you have to charge the highest rents. And the renter demand is the smallest, right? Most people want good functional housing in a nice environment and don't necessarily need to live on the top floor of a high rise. So we try to appeal to the widest market that we can get. But because we're doing development, it typically takes about 2 years to build them. And then depending on the size of the community that you're constructing, it may take another 18 to 24 months to lease it. Our communities are typically 300 to 400 units. So 2 years to build it, 2 years to lease it. And then at that point, we would put on, again, it's a 10-year life. So we would replace our construction loan with a permanent loan, given that this is a 10-year investment. And when we put that permanent loan on, that's when we would make the tax-free distribution back to you all to allow you to pay the taxes that come due in 2026, due in 2027. So we tried to be very thoughtful about the construct and the structure of our funds. So during the first few years, there's no cash flow because again, you're building it and leasing it. And then, call it, starting in year 5 and then through the term of the investment, it becomes a cash flow vehicle because you now have leased up, stabilized apartment communities. So the cash on cash at that point, starts at, 6 or 7% and then grows up to 8 or 9% as your rents increase over the holding period. So it's both a total return vehicle because when you sell them at the end of 10 years, you have a large amount of profit. But again, during years 5 through 10, it's a terrific cash flowing vehicle that you can utilize that cash to make other investments. Yeah, that's a great question. As the Derek Taylor folks mentioned earlier, there is depreciation. You don't depreciate it quite as quickly as you would a mobile home community, but between the operating and the operating losses and the depreciation, it's a very tax favorable vehicle because you can use those losses to offset the ordinary income that gets generated from the rental income. So it's a very tax efficient vehicle. Yeah, no, that's also a really good question. I can tell you, and I can't speak to all the other op zone funds that are out there. In none of our developments have we displaced anyone. So typically it's either a parking lot or it's maybe an abandoned industrial manufacturing facility that we're taking over. I mean, at the end of the day, we're a fiduciary to our investors, so getting you the returns, but in terms of the environmental, societal, and green impacts, we're also very sensitive to that in terms of the building materials that we use. And within the op zone legislation, you can, and I'm not an expert on that side of it. It's really the real estate side. There are businesses in terms of they can relocate to op zones, hire people in those op zones, and get the benefits that way. And obviously, we're creating a lot of construction jobs during the construction period, as well as once the assets are built and leasing, additional jobs. Right now, I think we're picking great partners and we're picking great locations. So I don't stay up at night worrying about that. Given the inflationary environment we're in right now, costs, candidly, lumber has gone bananas. That has settled down, but with commodity pricing being as high as it is, whether it's steel, drywall, electrical, plumbing, the cost of those materials have gone up. What we do to minimize that risk is we get what are called guaranteed maximum price contracts from our contractors, who in many cases are the developers. And what that does is it locks in the hard costs to build the building. So that's both labor and materials. So that's how it's a risk, and costs have been going up, but that's how we mitigate that risk. It's a good question. And by way of background, the original legislation that was passed was bipartisan legislation. So it was, Tim Scott out of South Carolina and Cory Booker out of New Jersey, who really, one's a Republican, one's a Democrat, who championed this legislation. So it had bipartisan approval. Right now, the talk about the legislation is really more about transparency. It was put together so quickly, they didn't really focus on that part of it. So, openness and communication, and we're acutely focused on it. And in terms of Griffin and our openness and transparency, as I showed you earlier, we've done over $20 billion worth of investments. And I think we've been successful really for two reasons. One is performance, right? If you don't perform, you're not going to raise additional capital. So I think that's part of it. The other piece of the prong is reporting. And we're incredibly, one, diligent in our reporting across all of our investment vehicles, and then two, openness and transparency about that reporting. So if it's bad news, we're going to let you know. We're going to let you know what happened and what we're doing. But in terms of the legislation, there hasn't been any talk about disbanding the program. It's just cleaning it up a little bit on the reporting side.
But I think that's the one thing that I like is caution. Look very, very yeah, the wonderful job of the house. But it's not an unlimited capacity. So, we're going to work closely with our partners, Soltis, to make sure we honor their desire to accommodate their clients. But I think that's probably the thing in America. That's the thing right now. We're getting to sell capital. And, we may have to tell people we just don't have capacity. That's going to be disappointing for our financial advisors. We're getting to that point. So we'll have a period of time and gap where we're probably out of the market with this particular type of offering. And we'll come back, assuming that Eric gets the green light saying we've got capacity to take on new offering. So that's one of the things. The other fund that I spoke to was more of a perpetual offering, more of a raising capital. So that offering will not close, and it's much more quick. So I think we're probably getting the hook here pretty quick. So I will just say, yeah, I think Clark just gave you the hook, so we probably got it. So listen, thank you so much. We'll be here to answer any questions. We really appreciate the opportunity to participate in this conference. Eric, thanks for making the trip.
Of course.
Thank you very much. We appreciate the contributions of our Griffin team. I made an omission, and I need to quickly clarify it. On the digital asset portfolio, a co-manager of that portfolio is Ammon Christensen. Would you stand up, Ammon? You can't have a digital portfolio and not have a millennial as part of the team. So appreciate all the work that Ammon does to support that effort. It's my privilege now to be able to introduce Jeffrey Hartman. He's a principal with Blackstone within the Private Wealth Solutions Group. He co-heads the Independent Wealth Management Channel, which partners with firms like Soltis. I just have to comment, Blackstone is a huge company, but the level of service and the information that's available and the responsiveness of Jeff and his team has been remarkable. There are 3 options that have been approved by the investment committee. Some of you have this already in your portfolio that's a little bit newer to Soltis, but Jeff will talk about the BREIT. That's the private real estate fund that's available, very powerful portfolio. And then another one is in the private debt space, BCRED, and also Big Flex, which is a secured floating rate with liquidity features. So with that, we'll turn the time over to Jeffrey Hartman.
Thank you, Hal. Slides work. This is awesome. I first want to thank Hal and the team at Soltis for putting on this event. It's great to see you all in person, in 3D. We all love Zoom, but I absolutely have Zoom fatigue. I have a large HD TV at home, and just over the past 18 months, I have a tough time seeing the score. Now that can't be because I'm getting old. Has to be because of Zoom. But it's great to be here in person. You and your team at Soltis. The team at Soltis does a phenomenal job for you. We appreciate the partnership. It's a privilege for Blackstone to work with best of breed wealth management firms like Soltis. We take that very seriously. So I'm going to do 3 things here in the next half hour or so. I want to make sure to leave time for Q&A. I want to make sure this is most beneficial to all of you. As Hal said, Blackstone is a large global private equity firm. The screen you see here in front of you shows where those assets sit. So we like to talk about numbers in our industry. You heard earlier that Soltis is a $6 billion firm, top 1% of all RIAs. Blackstone today is the largest alternative asset management firm in the world, with $684 billion under management. If you rewind about 5 years or so, all of that AUM was institutional. So pension funds, so think teachers' pensions, firefighters' pensions, corporate, government pensions, university endowments, sovereign wealth funds, so the asset funds of countries around the world. The group I'm in is called Blackstone Private Wealth. As pensions started to go away in the United States, Blackstone realized that if you don't have a pension, you lose your conduit to Blackstone investments. We manage today money for 31 million pensioners in the United States. If you asked any of those pensioners how their Blackstone investments are doing, they would have no idea. They are not directly involved in those Blackstone investments, but their pension has decided that investing a significant portion of that pension in Blackstone private market investments will give those pensioners a higher probability to have a secure retirement. So my parents have a pension, I don't have one. As pensions started to go away in the United States, Blackstone realized we need to launch a private wealth business that serves individual investors. We thought individual investors would have some demand for institutional Blackstone private equity, private credit, private real estate. So to take a step back, the firm was founded back in 1985, and it is not to be confused with BlackRock. This happens once a week. It's no problem. Blackstone, BlackRock, I get it. Coincidentally, BlackRock is the largest manager today of stocks and bonds. So BlackRock iShares, I think they're somewhere in the neighborhood of $8 trillion. So on the long only side, on the stock and bond side, BlackRock is the largest asset manager in the world. On our side, on the private side, Blackstone is the largest. And our two co-founders were Steve Schwarzman and Pete Peterson. Schwarz in German means black. Peters from the Greek Petros means stone. So Steve Schwarzman and Pete Peterson decided to call the firm Blackstone. They had $400,000 between the two of them. Didn't take in any outside funding. They had really impressive investment banking backgrounds at Lehman and other firms. Didn't like the culture at those firms and what was happening to Wall Street. They said, let's start our own private equity firm where it's all about the end investor. They started that firm with $400,000. They talk a lot about the rejection they received in those first 2 years. It was really challenging to raise capital when you don't have any track record. So it took them 2 years to raise their very first fund. It launched in 1987. And here we are today with about $700 billion of assets under management, largest private equity firm in the world. And the analogy they use is a restaurant. And I think Soltis would agree to this. Blackstone is not a great firm because we are large. Soltis is not a great firm because they manage $6 billion. It's about the people, it's about the performance, it's about the trust and confidence you all have in Soltis, which makes them a large firm. The same exists for us. And the restaurant analogy is, if you go to a good restaurant, I'll take good out of it. If you go to a restaurant and you have a great meal and a great service, you're likely to go back to that restaurant, try different things on the menu, tell others about the great restaurant you went to. The same applies in our industry. If end investors, whether it's those of you sitting in the room or it's institutions, endowments, sovereign wealth funds, don't have a good experience with Blackstone, our firm doesn't grow. So we take that seriously, that same standard of care with every single deal, every single fund. It's all about the end investor having a positive experience. Our size is simply a function of the trust and confidence that our customers have in us. And when I was hired at Blackstone about 5 years ago, it was drilled into my head that Steve Schwarzman has two rules for the firm, and he's still our CEO. Don't lose money. That's number one. And number two is never damage the brand. And both are equally important. Not damaging the brand is about not cutting corners, doing things the right way, complete transparency. And that's the culture of our firm at Blackstone today. So I mentioned those delicious meals at the restaurant. We don't serve meals at Blackstone. Our meals are the performance delivered from our funds. So as you can see on the screen, this goes back to the founding of the firm back in 1987. Our average real estate fund has delivered a 15% return net of fees, private equity 15, secondary private equity 15, tactical opportunities 12, and credit 10. That's back to inception. During this time frame, the S&P 500 has delivered about a 9% return. So that is why the largest institutions in the world and pension funds and endowments and now individual investors choose to invest in Blackstone. Better performance. There's something called the illiquidity premium in private markets. We don't do anything with stocks and bonds at Blackstone. That's BlackRock that does stocks and bonds. Typically with private funds, your money's not liquid every single second of every single day like you have with individual stocks. So if you're going to invest in private market solutions, whether it's private equity, private credit, private real estate, the three kind of major food groups of alternative investments, you should expect better performance. Otherwise, you'd prefer to be liquid, correct? So this is Blackstone's performance going back to inception. We've launched just over 50, 10-year illiquid private funds since Blackstone started. Not a single one of those funds has lost a penny for investors start to finish. And here's the performance you can see across those major food groups. So really impressive track record. And again, we're only as good as our last meal. So every new fund that Blackstone launches, especially in the individual investor community, has eyes on it, same standard of care. We want to deliver that same outperformance for investors. This just shows you the global nature of Blackstone. So 26 offices, 3,400 employees is a little bit outdated. We've been growing really quickly as of late. We'll have 4,000 employees at the firm by the end of 2021, and 550,000 portfolio company employees. So a stat about Blackstone, private equity is we're making control investments in private companies or public companies, taking them private. Anybody heard of Ancestry.com? So based in Provo, Utah, Blackstone Private Equity acquired Ancestry.com for about $5 billion at the end of 2020. Vivint is another Provo-based company, one of Blackstone's portfolio companies. If you add up the employees of all of Blackstone's portfolio companies, we're the second largest employer in the United States, behind Walmart. So again, we don't talk about that size and scale to beat our chest. That size and scale gives us tremendous information advantage when we make investments. All those portfolio companies give us proprietary private data that is not public. You've probably heard of inside information when you're talking about publicly traded stocks. It's illegal to trade on inside information. In the private sector, private equity, it is all about inside information. We don't have to share any information we have from any of our portfolio companies around the world with the public. But that information is very valuable on the real estate side, the private equity side, the private credit side, because we know what's going on. We have boots on the ground all around the world, and it helps us make smarter investments. So I'm going to hit on, I talked about who Blackstone is a little bit. I'm going to hit on the two investment strategies that are really changing the industry, both of which Soltis has done 6 to 8 months worth of diligence on and has decided they are a fit for Soltis, for those of you that are appropriate to the extent it makes sense for your portfolio. The first one Hal mentioned is real estate. So about 5 years ago, we launched the first ever Blackstone private real estate fund that individual investors had access to. So instead of a $10 million minimum investment's $2,500. Instead of 10 years of illiquidity, how about monthly liquidity? You can have access to your money once a month. The strategy is called BREIT, Blackstone Real Estate Income Trust. And we wanted to address the three issues that financial advisors and individual investors had with some of these private real estate funds in the past. And those three issues are fees, transparency, and liquidity. So we significantly lowered the fees. We made it transparent, so you know the value of your investment every single month. And we added this monthly liquidity feature because individual investors, unlike institutions, don't really love 10 years of illiquidity. They'd prefer to have access to their money on a more frequent basis. So we spent over a year structuring this product. We wanted it to be unconstrained when it comes to the real estate investment mandate. So we can invest in any type of US real estate. The four core sectors are office, industrial, retail, and multifamily. And then you have some of the ancillary sectors you heard about today: manufactured housing, data centers, self-storage, university student housing. We launched it January of 17. It had 0 assets, 0 investors. Today, it's a $60 billion fund with a B, 1,600 pieces of commercial real estate in the portfolio, and over 150,000 individual investors have purchased shares of BREIT. And I have to be honest with you, when this launched 5 years ago, even Blackstone, the firm, wasn't quite sure of this individual investor business. There were like 12 people in the corner at 345 Park Avenue. The partners at the firm are wondering what these people are doing, talking to individual financial advisors and investors. Today, Blackstone Private Wealth is the fastest growing business within Blackstone. 20% of our firm's AUM today comes from individual investors. Just an unbelievable business and growth and adoption by the top wealth management firms in the country. Individual investors should have the same investment choices as the Harvard and Yale endowment and CalPERS and CalSTRS. Why should it be a different product with a different team? The same partners at Blackstone that manage money for CalPERS and the Harvard endowment manage your portfolio, BREIT and BCRED. So anyway, it's been fantastic growth. The performance has been phenomenal. Go ahead, Al. I did. You want me to announce it again? No, it's always been monthly liquidity. Yeah, monthly. Yeah, so for BREIT, you can invest once a month, you can get out once a month, your income is paid monthly. There's a lot to like about commercial real estate. You think of stocks for growth and bonds for income. There's not much income to be had today. I don't think we need to beat that horse anymore, but bank CDs are at 1%. High quality bonds are at 2 or 3%. This portfolio pays a 5% distribution monthly income, 1099 tax form, and it's averaged 12% total returns per year net of all fees since inception. So Blackstone got the structure right, fees, liquidity, and transparency. It's one of the top performing real estate funds in the industry, but that liquidity piece is really important. And Hal, I'm glad you highlighted that. A lot of private real estate funds, you are completely illiquid for 5, 10, 15 years. And you kind of cross your fingers that whatever they bought for $1, they can sell for $2, 5, 10 years down the road. The beauty of this portfolio being liquid is it is appraised by a third party every single month. So the assets we own in the portfolio, inflation is real. We don't believe it's transitory. As inflation is occurring in our country, every single month, the value of that $60 billion worth of real estate increases in this environment. The fund's up 19% year to date through August. You can sell out next month without a penalty and take 100% of your capital out. So that combination of high quality institutional real estate that's unconstrained, paired with that monthly liquidity feature and $2,500 investment minimum, makes for a investment strategy that individual investors really like. It can really help their portfolio. I myself am a BREIT investor. My parents have 20% of their nest egg in BREIT, and my dad still complains to his financial advisor, why can't I have all of it in BREIT? And I tell him to settle down. There's something to diversification. But just a phenomenal success story for Blackstone. But again, it all gets back to the end investor. If that total return was not 12%, if the income yield wasn't 5%, if it didn't have tax benefits, last year, 100% of that income stream was non-taxable. So if you have BREIT in a taxable account, because we can pass through the depreciation of the real estate, I use $1 million example. $1 million investor last year collected $50,000 of income paid monthly. They got their 1099 at the end of the year. It said you owe $0 to Uncle Sam. 100% of that taxable income was offset by depreciation. And it won't always be 100%. We guide towards 80, but a very tax efficient income stream. So again, real estate's this hybrid asset class that gets you growth like the stock market, but also generates income to the tune of 5% in today's environment. What has helped us on the performance side, just as much as what we own, is what Blackstone decided not to own. So we launched this 5 years ago, pre-COVID, and our real estate folks made the decision, we're not big fans of office, and we're not big fans of brick and mortar retail. Those are two of the largest sectors of the commercial real estate market. They represent less than 2% of our entire $60 billion portfolio. They made the decision that e-commerce is here to stay. Anybody have the Amazon Prime app on your phone? I've become a really good box breaker downer guy. Every weekend, I've got about 15 boxes to break down in the garage. We're all ordering more online. All those goods have to be stored somewhere. So we love distribution centers. And you've heard some of the previous speakers talk about housing. There is a major supply-demand imbalance in the United States when it comes to housing. We're somewhere in the ballpark of 6 million housing units short in the United States. That's individual single-family homes, multifamily apartments, manufactured housing, all of housing. So as long as that supply-demand imbalance exists, we're going to see values increasing in any sector related to housing. So 80+% of this portfolio is those two sectors. And we dabble around the edges with sectors like data centers, manufactured housing, self-storage, et cetera. We bought some large assets on the Vegas Strip in this portfolio, the Bellagio, the MGM Grand, the Mandalay Bay, 30-year triple net lease, just a cash cow type property. That comes with rent guarantees from MGM, the parent company. So again, mitigating our downside risk, maximizing the income stream. So really attractive portfolio on the real estate side. I'll hit on BCRED real quick. And then I'll be happy to answer any questions you have about Blackstone, the firm, or BREIT or BCRED. How am I doing on time, Hal? Am I out of time? Huh? 2? 9, perfect. So BCRED, real quickly, Blackstone Private Credit is a direct lending strategy. Why investors are attracted to this is easy. Interest rates are really low. This pays an 8% income stream, monthly income in today's environment. We launched it January of this year as kind of the sister fund to BREIT. We thought we had checked the box on private real estate. We wanted to create the same exact structure of product, but give folks access to private credit as a replacement to or a complement to traditional bonds in this low rate environment. So BCRED has an 8% yield paid monthly, 1099 tax form. And the terms of the loans are floating rate versus fixed rate. So as interest rates rise, we as the borrower, or excuse me, we as the lender, you as the investor, collect more money. So a rising interest rate environment is just fine for a floating rate strategy. It really hurts a fixed rate strategy because how bonds work, when rates go up, the value of your bonds goes down. A floating rate strategy is a really nice hedge. So between the 8% coupon and the fact that this is all senior secured first lien floating rate debt, it makes this a really attractive asset class for individual investors. Why lenders would prefer to go to a private lender like Blackstone than to a bank? We've heard a lot about kind of removing the middleman and cutting out the bank. This one's simple as well. All we're doing is financing private equity transactions. Are any of you in the room business owners? All right, what's your business? I'm gonna put you on the spot. Painting contractor. So if I'm Blackstone or Carlisle or TPG, Apollo, and I decide I want to buy a painting contractor company, and your EBITDA is $100 million, I'm going to go in and say, I want to buy your company, and in today's environment, I'm going to give you a 10x multiple. EBITDA is just a fancy way of saying operational cash flow. So I'm going to buy your $100 million cash flowing company for $1 billion. Sold. He's in. A negotiation is shorter than most. So me as the private equity firm, I'm not putting $1 billion of my fund down to buy your company. Private equity utilizes leverage. A typical private equity deal will be half down and half with a loan. So I'm going to put 500 million of my fund down to buy your company. I have two options on the other 500 million. I can go to the banks, and it'll be Goldman, JP Morgan, Scotiabank, Deutsche Bank, et cetera. It'll be 3 or 4 of those banks. So I'll have multiple counterparties. They will tell you, do you have a credit rating for your company today? You do have a credit rating? All right, let's pretend you don't. If you don't have a credit rating, they're going to say you need a credit rating from S&P and Moody's, because we're going to originate this loan and then get it off our balance sheet and syndicate it. It'll cost you about $1 million to get a credit rating from S&P and Moody's. This process is going to take 3 to 6 months. There is no speed and certainty on the close. And you're going to have to do an institutional roadshow to market what will become a publicly traded senior loan in the marketplace. You say, okay, that's interesting. It seems like a lot of bullets there in that process. Call Blackstone. No credit rating needed. We'll close with speed and certainty in 30 to 45 days. And we will not originate the loan and get it off our balance sheet. We will partner with you for the entire 5-year term of the loan and introduce your company to all of Blackstone's portfolio companies. Anything you buy within your organization, you will buy with the heft of Blackstone. So we can reduce costs for you on anything from healthcare to cell phones to FedEx shipping. The average company we loan to increases EBITDA by 6% in the first year. So for your company, 100 million of EBITDA, 10x multiple. If I can increase your EBITDA from 100 to 106, I just created $60 million of increased enterprise value just because you chose me over the banks. So for all those reasons, private lenders today are replacing the banks. These private equity sponsors, these underlying companies do not want to go to those banks because of all those headaches. And I haven't even mentioned the government intervention that stemmed out of the 08-09 financial crisis. Dodd-Frank, Basel III, the Volcker Rule. Banks just aren't involved in these private company loans like they used to be. So long story short, that is BCRED. You are simply replacing the bank. Every loan we make, we typically collect an additional 1% on that loan versus what they could get by going to the banks. But they don't want a transaction. They want a partnership. They want the Blackstone stamp of approval on their company. They want all the benefits of being part of the Blackstone ecosystem. And the 6% EBITDA growth is really nice for their investors and the private equity sponsor. So that's what BCRED is. It's simply a direct lending platform. And as a company, just like in a REIT, we have to pass on at least 90% of the net income we collect as a company. So that's where your 8% yield comes from. And if interest rates rise by 1%, a year or two from now, your yield might be 8.5 or 9%. So a really nice inflation hedge, really nice interest rate hedge, and a way to make really strong current income in the environment today. Again, we launched the fund January of this year. It's about an $18 billion fund today. So it's attracting a lot of attention from both institutions as well as individual investors. So those are the two core Blackstone funds, both perpetual in nature. They'll always stay private, open for business once a month. They both have the liquidity feature. So with that, I'll stop. I got to be close to that 9 minutes. $2,500 on both. Yes, sir. I mean, right now, there isn't enough high quality real estate to meet the demand, which is why prices continue to rise. But on the residential side specifically, after that 08-09 financial crisis, developers stopped building to the extent they were before 08 and 09. For household formation in the United States, we need about 1.2 million housing units every year just to keep up with organic household formation. We need 1.5 million. Since 08-09, we've only been building 1.2 million units per year. So think about that, 300,000 units short, 2010, 11, 12, 13, 14, 15. That's where that 5 to 6 million housing units short comes from today. So huge supply demand imbalance. And today, especially on the housing side, developers can't develop as quickly as they'd like because of the rising costs of steel, copper, labor, et cetera, lumber. So supply is limited, demand is really strong. So we think for a core plus portfolio like BREIT, we're not doing any development. We're not doing any like fixer upper real estate. It's all high quality, recently built, fully occupied, cash flowing real estate. We think the market's really strong. And again, our fund's up 19% year to date. We may do something like 22 or 23% this year. That is not sustainable. This type of real estate should net you about 8% per year. If you look back at the 40-year history of the NCREIF Odyssey Index. But in today's inflationary environment, if you're in the right sectors and the right geographies, now we say we like the smile states. So think about a map of the United States, a big smile on it. So from California down to Texas, up through the Carolinas, those warmer weather areas, states like Denver and Arizona, Utah. If you're in the right sectors and the right geographies, we think you'll do really well in commercial real estate for the next several years. Yeah, so both have, BREIT has monthly liquidity. BCRED is quarterly liquidity. So BCRED is 4 liquidation opportunities per year. BREIT is 12. Both of those products have a 1-year, what's called a soft lock. So if you choose to liquidate BREIT in the first year, you'll incur a 5% early out penalty. That actually doesn't go to Blackstone. It goes back to benefit the existing shareholders of the fund. Same thing applies for BCRED, but it's a 2% penalty, not a 5% penalty. So you want to make sure you're comfortable holding these private assets for at least a year. After 12 months, you can get out once a month, 100% of your investment. We haven't turned down a single investor since BREIT launched. We've never had to gate the fund even through 2020. So every investor that has sought liquidity has been able to gain all of it with no issues. And 2020 was a really good test for us. 2020 was a volatile year, and we had a couple months there where there were $400 million of liquidity requests from BREIT. But when you have a $60 billion fund, a lot of institutional sticky capital, we had no problem freeing up that capital for our investors. Question front? That's just the yield. Yep. Great question. So I mentioned real estate being an inflation hedge. You should expect the income you collect from any real estate portfolio, whether it's a rental home you have here in St. George or a portfolio like BREIT, to keep up with inflation or outpace inflation. Our income stream has outpaced inflation since we launched it. So it's paying a 5% yield today for new investors coming into the fund. If you purchased BREIT in 2017 or 18, you're collecting more like 5.9%, 6%. So our goal is to grow that income stream over time to outpace inflation. So it's not only an attractive current rate, it should grow over time for you. You should get a raise with inflation. I'm out of time.
So I wanted to just make sure, because one of the great features of Blackstone is that as a private investor, you can't just go straight to them. They have catered to the registered investment advisory market, and we appreciate that about Blackstone. So thank you, Jeff.
Thanks, guys. We have one presentation, and then we're going to grab lunch and then have our final, I think you'll really find it entertaining. Soltis, we work with you and partner with several very good estate planning firms. And we really take a lot of time to think about who these attorneys are and the estate work that they do for our clients. And we'd like to introduce Braden Bangeter and Bill Frazier. Bill is the managing partner for Bangeter Frazier, the Bangeter Frazier Group. We've known their senior team for a long time and have a lot of respect for them. So we'd like to just have you come up without any further ado. They're going to give us a little bit of an update on current estate tax legislation with the current administration that we think might be interesting. When they're done, we're going to go out and we'll give you some instructions on lunch. Braden and Bill.
Thank you so much. We just want to thank Hal and Kim and Clark Taylor for having us here. We're really grateful and excited to talk to you all about this. And it affects everyone because everybody here was born and everybody's going to die. It's inevitable. So we're passionate about estate planning. And just to give you kind of a quick background of Bill and I and BFG, Bangeter Frazier Group. BFG came to St. George in 2004. And it started as a civil litigation firm and did a lot of insurance litigation. And Bill became an expert in litigation. And with all the different changes to taxes and estate planning and how there are tax implications on your estates and gifts, Bill saw the necessity to bring good estate planning to St. George. And with that, we're licensed in Utah, Nevada, California, Arizona, and Washington, and we've been able to kind of spread our wings and do a lot of estate planning in all of those states. So it's been great. So there we go. With the estate planning, I'm going to turn this a little bit. With the estate planning emphasis that we've developed at BFG, we have a lot of clients that have put it off. And especially with COVID, we've had just a huge rush of people needing estate planning. And it's kind of funny because they'll always come to us and say, man, this is a really morbid topic. And, you know, we just kind of laugh about it. Happy Halloween. The estate planners are here. So it is a morbid topic because we have to talk about your death and we have to plan for it. But it's important to be able to shape the path for all of the assets that you've worked your entire life for. So with legislation, there's been a lot of tax changes over the years. And with the unified tax credit, it's essential that you understand how that affects your estate. Now, in its most basic form or definition, the unified tax credit is basically just a tax exemption that allows you to gift during your life and also after you pass away to beneficiaries in hopes that it doesn't just get taxed and taken by the government, right? And so they've created this tax credit where up to a certain threshold, you can gift during your life and also after you pass away without federal estate taxes applying and also state estate taxes. That threshold in 2021, if you're worth over $11.7 million individually, so you're not married, you're just an individual that has $11.7 million or over that, or if you 23.4 if you are married, so jointly it combines the threshold, then the government will not tax your gifts to other people and your estate after you pass away. Once you exceed that threshold as an individual or as a married couple, then the government will graciously accept your payments to it. So the tax credit is applied to gifts while you are alive and then also combined with your estate after you pass away. So just as an example, if you gift $10 million, and this is currently with the $11.7 million threshold, if you gift $10 million during your life and you pass away and you have over $1.7 million left in your estate, that tax is going to then apply, and it's roughly 40% of the estate. So it's pretty substantial, and that's why it's so important that we really plan before we pass away. So there is some confusion sometimes when we're talking to our clients and they just talk about general estate taxes. Now, there's a federal estate tax, and then there are state estate taxes, and they're different. So 17 states have state estate taxes, and then also inheritance taxes on the beneficiaries. Utah is not one of those, so we just have the federal estate tax. So as we all know, the beginning of time was in 1997. And that's when things really started to shape and increase for the unified tax credit. I won't bore you with the names of the legislation and the mouthful that they are, but we'll just kind of review the timeline so you guys have a good knowledge of the evolution of this unified tax credit. So in 97, they legislated to make the $600,000 threshold go up to $1 million by 2006. You'll notice that by 2002, it was already there. In 2001, they passed an act where they would allow it to gradually grow through 2010. And then in 2010, they set a minimum of $5 million on the unified tax credit. And that was supposed to be repealed after 2 years. So in 2012, they made the $5 million unified tax credit permanent. So that was like the minimum, but it could go up. In 2017, under the Trump administration, they passed the Tax Cuts and Jobs Act, which is actually like the easiest one to say out of all of these. And it increased to $11.18 million for an individual. And that's set to sunset at 2025. So it's coming up. So right now it's at $11.7 million, as we discussed. And it's interesting because it's set to sunset in 2025, but the current administration is discussing cutting that in half before the sunset. Let's see here. So there is kind of a discussion about, it's kind of like a use it or lose it policy. In the event that the estate tax modification is made in January under the Biden administration, high net worth individuals will need to consider gifting assets, perhaps to charitable remainder or similar irrevocable trusts. So just as an example, a little hypothetical, assume President Biden signed the law into effect and it reduced the unified tax credit by 50%. So it became $5.85 million effective January 1st, 2022. And this is what they're discussing. A single person with an estate worth $10.85 million could gift $5.85 million to a charitable remainder trust or other type of trust vehicle that we can help with on December 31st, 2021, with no clawback if it's done before the law takes effect. If that person dies in 2022 with a $5.85 million estate, assuming that the new threshold was $5.85 million, no estate tax would be owed at the federal level. And in Utah, you wouldn't owe the state estate tax. So if you exceed that threshold, you can see the value in understanding what's happening here. If you have assets worth 11.7 or above, it's really important that you start looking at this because they're talking about cutting it in half. And so I'll go ahead and pass the ball to Bill Frazier, who's our managing partner and owner of the firm, to kind of talk about strategies for that.
Thank you. So you don't see any of these numbers going down, do you? In fact, in the history of our republic, this unified credit number has never gone down. So it is a bit of an interesting development to see some discussion about sunsetting early. And ever since the late 90s, we've had these sunset dates. And every time they come up, a lot of times both parties don't want there to be individuals captured unintentionally. I'm from San Francisco. My grandparents owned 2 homes. They paid 30 grand each for them. And they've appreciated significantly. And a lot of times that cuts across parties. And so it's not a very popular thing to increase estate tax. So how do we deal with this in the future? One of the ways that we see underused here in the states where we practice are charitable remainder trusts. And they have various annuity features or unit trust features depending on how consistent you want your income to be. And we've heard a number of great presenters today talk about the import of taking it in an approach that has some advantages as to taxation. We got to get into the qualified opportunity zone before 2021 if we want XYZ. And if we're going to take advantage of some tax benefits with regard to estate taxation changes, those will have to be done somewhat rapidly depending on our view of the news. A lot of times they will, by the way, the targeted jobs TCJA was passed on December 22nd, 2017. There wasn't a lot of time to get stuff done before 2018 if you needed to. A charitable remainder trust is one of the least used but the most effective tax avoidance vehicles. And the idea is we're going to take an appreciated asset and put it into a charitable remainder trust. That means after you die, the remainder goes to charity. But we've heard from a number of excellent providers today as to how do we invest that income? Because when it's in that charitable remainder trust, 2 things happen. One, you get a tax deduction for the amount that you put in there. It's not 100% because there's a present value calculation. The charity is going to get that money sometime in the future, but we don't know when that future will be. So the second thing that happens is that money could still be managed by you. You could direct where it goes. You could be a trustee, and that money could be paid back to you as a lifetime beneficiary. So if you invest and you make 8% a year, not only do you get that, it's almost like depreciation with some of the apartment complexes and mobile homes we learned about, that tax deduction could offset the income that you earn. Now, one of the most fascinating ways to avoid your heirs being upset that you've given them nothing, if everything's in a charitable remainder trust, is you could use the income you get to fund or superfund life insurance policies. And how much is taxable from life insurance proceeds after you die? Exactly. I saw a lot of zeros, and that is true. So you have a situation where you could have lifetime income, you could fund something for your heirs, and support charity, all at significant tax benefits. Now, the other 2 things that are dynamic, and I tapped this together here earlier this week, and even this morning as I was sitting here, I noticed some tax alerts about capital gains and reconciliation bills. But the proposals that are happening right now are really discussions about changing the top rate of capital gains. The most recent one that was sent by the House was to propose to cap it at 25%. So obviously it's a significant percentage increase over existing numbers. And the discussion regarding stepped up basis, thankfully, has been entirely removed from the most recent reconciliation bill. And stepped up basis, that's our favorite tool in the law. 1031 exchanges or stepped up basis, you can defer the gain. And then if you die, your relatives don't have to go back to your basis. They go back to they get an artificially stepped up basis based on the value of the property at the time of your death. So at the end of the day, while this is a dynamic situation and we have a number of things that are happening, we're seeing the most likely culprit for heartburn for estate planning attorneys being the changes to the estate tax. Right now, as it stands, it's very likely that something, perhaps for the first time in the history of our republic, is going to happen. And that is either an early sunset of the 2025, December 31, 2025 date set by the Trump administration, or the actual sunset being achieved, which hasn't historically happened, but that seems to be the direction that we're heading. So regardless of which vehicle you choose, whether you need charitable planning or if you need tax avoidance planning, your estate plan could be an important part of it. And we really work hand in hand with excellent RIAs like Soltis to ensure that not only have we created a plan, but we're implementing that plan in a way that's tax advantageous to you. Since everybody wants to listen to a lawyer right before lunch, right? So I'll leave you with this. What is black and brown and looks great on a lawyer? A Rottweiler, but close. Thank you all very much. It's been a pleasure.
Thank you, Braden and Bill, for those. Jim Moop, and to have him introduce our final speaker.
How are we doing? How's lunch? My name is Jim Muya. I'm with CNL Securities. Thank you all. We appreciate your time. We appreciate you being here. To Hal, Kim, and Clark, and the entire Soltis team and family, we are blessed for our friendship and our partnership with you all. And I've attended a lot of conferences. Today's conference I thought was amazing, right? A lot of great content. The sponsors did a phenomenal job of delivering value. And I think what you heard a lot today really speaks to what makes Soltis so different and unique in our industry. And what Soltis does an exceptional job of is for 30, 40, 50 years, there has been this imbalance of access that the big boys and girls got, the foundations, the endowments, the pension funds, and then what all of us got as individual investors. So really what Soltis delivers to you as a client is a true institutional approach to managing your money and managing your investments. And that's what they do better than anyone in the industry. So congratulations on working with Soltis. They do a phenomenal job. And again, we're tremendously blessed for our partnership with them. CNL, thank you all. We deliver a really unique private equity strategy. It's a strategy that's been around for 38 years. Private equity, as you all know, simply allows you for the first time now to own equity or own stock in private American companies that are not publicly traded. So that's what we're offering to you. It's a great complement to your publicly traded portfolios. Christy Behunin, congratulations on making partner. Tremendously, tremendously well-deserved. She's just an incredible rock star. So congratulations. Yes. So let me introduce my colleague, my friend, my mentor, Dr. John Rhodes. So Dr. John Rhodes has been in the industry for over 40 years. And Dr. John Rhodes does a lot of presentation at client events like this and a variety of industry events for 40 years. Does a lot of coaching and a lot of teaching to clients and financial professionals.
Dr. Rhodes received his bachelor's and master's from the University of Georgia. So if you're a Bulldog fan, there's the biggest fan right there sitting in the corner. He also received his doctorate from Georgia State University. Dr. Rhodes, this is one of the coolest things to know about Dr. Rhodes. Dr. Rhodes is a veteran of the Vietnam War. He was a commander of his Army group. And I want to get this right. He was awarded the Bronze Star of Valor for her service in the Vietnam War. Yes, thank you. Last thing on Dr. Rhodes, he has been married to his lovely wife, Gloria, for over 50 years. Yes. I know Dr. Rhodes very well. That applause, Dr. Rhodes, is for Gloria, not for you, because that's an amazing woman. 50 years, God bless that woman. So with that, let me introduce Dr. Rhodes. And what we're going to talk about today, and this is a part of what Soltis does, is what's your life score? What Soltis does is not only manage your investments, but as their mission statement talks about, is they want to manage your investments so you can really pursue and enjoy your life endeavors. So we're going to have a little fun this afternoon for about 30, 35 minutes, and Dr. Rhodes is going to walk through an exercise of what is your life score. And so with that, ladies and gentlemen, Mr. Dr. John Rhodes. Thank you.
Thank you. My mother would have believed every word he said. No, it's great to be with you. It's great to be with Soltis. I tell you, the CNL and this company have such a same culture. CNL was founded in 1973, and Jim Seneff, the founded the company, put together a 50-year business plan, and it's so much is what you saw today, and I think today's been great. The music last night was phenomenal, and I asked to speak while you were eating because when you're enjoying the food, I normally get better remarks. And but you have a piece of paper of this on your table, and I know you're eating, but let me just go through this with you. It should be on your table, and if you don't have one, we have some other copies here. The reason I want you is entitled, "What's the life score?" So say it looks like this. But you have two pieces of paper in that folder. One is an orange card, and has my telephone number and everything on it. And then it's a green sheet. The motto of all the coaching I do is continuing progress, not perfection. And the way that I strive to continue to make progress is by getting feedback from great people like you. So I ask you if you would take the time before you leave your table and when we finish to fill this out and just give me your comments and thoughts about our time together today. And then if you're in a position to where you can take a second away from that good food, let me tell you what I'd like for you to write on the orange card. Action, I will take. Action, I will take. And the reason I do that is you're going to enjoy your lunch. But if we spend 30, 35, 40 minutes together and you do nothing of the things that we've talked about, I'm going to be disappointed. And so I'm hoping that you will get one thing from our conversation and from our time together that you will do. And you'll write it on that card and you'll take it and put it in your pocket or purse and take it with you. If you leave it on the table, I'll follow you to your car. Even in the rain. No, you know, as I'm sure I'm the oldest one in the room. And many years ago, as I worked with people and look back, I would see people that said, I wish I had done this in life. I wish I had done that in life. And so that's when I put together the part that in regards to what's your life score. Now, I'm living in 20 miles from University of Georgia campus. It's big football. And we have about 100,000 visitors that come to Athens about every other week on Saturday. And it's all about the score. But I really think the most important score beyond sports, and it can be government scores, sports scores, credit, medical. The most unusual I've ever seen is when a lady in a particular city, she graded all of the public restrooms in that city so that the ladies would know which restrooms were the best rooms or had the best score. Before we go any further, I'd like for you to write something else on that orange card. And I'm not going to take these up so you can be very honest with it. What's the 5 most important things about life to you? Take a minute, and if you can, and write that down. What's the 5 most important things about life to you? I have some people say I've never done that. I've never written it down. I did have a lady in North Carolina. Her husband was right above the dog on the 5 most important things. What we're going to do today is we're going to talk about 10 parts of life. And you have that in the folder. And you see those 10 areas, and we're going to talk about those. And then I'm going to ask you to grade yourself in each of those 10 areas. Give yourself a score of 1 to 10. And then I'm going to ask you to turn the page. And what you will do, you'll see on the page is where, for example, in management of time, if you gave yourself a 7, you put a dot on number 7. And then at the end, I'm going to ask you to connect the dots to see how balanced the wheel looks. I had a fellow in Boston said, Dr. Rhodes, if I had to ride home on a tire that looked like this, it'd take me a long time to get home. So that's what we're going to go through in the next few minutes. Why didn't I start with time? We all have the same amount. That's one thing. Everybody in this room has the same amount of time. As we look at time, prioritize and calendarize. You know, if we don't put on our calendar or ask ourselves what's important, it's back to the 5 most important things. And what's important, we need to have on the calendar. But we need to determine what we're going to do. You know, when I got back from Vietnam and was working at Georgia State University in Atlanta, I read books on time management because here I was, a husband, a dad, a full-time employee, went to church, exercised. I could spend a lot of time in any one of those, but I had to prioritize what I did. Do you know that what the greatest challenge to time today is? I did this once with a lady who looked at 2 phones. She said, that's absurd. How many of you have seen people come into a restaurant and sat down? I don't know why they came together. I mean, really, I saw a family come into a restaurant recently, husband, wife, and 2 boys. They were looking down the whole time they were together. Now, that's one thing I've noticed today, and Clark and Kim, it just shows you what a great program you put together. As people were speaking, I looked out over the group and very few were on their phone. That's a tribute to this company and to the program that they put together, just for sure. But managing electronics. I had a fellow say one day, I said,
You know, it's important to manage time. It's important to cut this off. When our grandchildren, when they were younger, they would come to the farm. I would tell them, I said, we're going to have some EFTs. They said, Papa, what is an EFT? I said, it's electronic free time. Give me your phone. I mean, you would have thought I was going to shoot them. I had a man call me several years later and he said, Rhodes, you need to talk more about these EFTs. He said, you know, we have 2 daughters and the amount of time they're spending 24 hours a day, in some cases off and on the phone is ridiculous. And we think we should have some EFTs. So my wife and I talked and we decided that 10 p.m. would be electronic. From there to the next morning, would be electronic free time. He said, Rhodes, when we announced that the next day, you'd have thought we were going to beat them. You'd have thought they were going to call Family and Children's Services. And he said, but cutting the phone off, you know what you have to do if you do that? They bring the phone to your room. Some of you, I know you have a Chick-fil-A here. Chick-fil-A for a while there had a house. It was a box that you could get when a family came in and put on the table. And if everybody put their phone in the box while they were having a meal, remember that? They'd give you ice cream for dessert. But it was a way of managing that. And I said, because it's important how we use our time and how we learn to turn those off. I had a man came back later and he said, Dr. Rhodes, you know what I realized? I take my little girl, 8 years old, to McDonald's every Saturday for breakfast. And said, when I'm on the way over there, I'm on the phone. We go in and get a Happy Meal. I'm returning emails. I said, would you do me a favor? I said, next Saturday when you and your little girl go into McDonald's parking lot, when you get out of the car, I'd like for you to say, I'm going to leave my cell phone in the car. He said, why would I do that? I said, I would like for her to begin to know you can put it on. He came to the next coaching session and he said, Dr. Rhodes, do you know when we pulled into the parking lot and I told her I was going to leave my phone in the car? She said, really? He said, what she realized? My phone had been more important than her. And said, now when we go get the Happy Meal, no phone, we have a different time together. And I think adults or children really have to learn to manage electronics. And it can be great. I mean, we've already seen, we've talked about it here today. Look at what's happening. I know we were laughing with Zoom. And I tell you, I didn't grow up with Zoom. And learning to do that. Learning to use technology. Clients have had to learn. Financial professionals have had to learn. Do you have any time for me? Do you have any time for a spouse? So what I want you to do is to grade yourself 1 to 10 and put a dot on that number on the wheel. Next is physical health. Good health, the value of which is seldom realized until it's gone. Is health important? It is. Let me ask you a question to the group. How many of you in here have had a physical in the last year? Raise your hand. Oh, I like, hold them up, hold them up. If your physical lasted longer than an hour, keep your hand up. If it lasted longer than 2 hours, 3 hours, 4 hours, I need to know where you go. How many of you have heard of Dr. Ken Cooper? Dallas, Texas. I started reading about Dr. Cooper 45 plus years ago. I started taking people. We had a coaching session in Dallas, and we would meet at the Cooper Center. Dr. Cooper, when he graduated from medical school, he was saying, why do we have to wait until someone gets sick before we try to help them? Why don't we try to keep them healthy? And they are one of the top places in the world for physical. When I go to the Cooper Center for physical, I'll go to the center and I'll get a room at the end there on their campus. My physical will start in the morning about 7:30. About 2:30 tomorrow, I will meet with Dr. Cooper. He will go over the results of everything. And many times he will say, John, I think you need to go back and get this test or have this test. I've sent many people, many clients out there. I had one that had been a professional athlete. He came back, he says, the greatest health experience I've ever had. I had financial professionals that coordinated and took 3 clients to Dallas. 2 of the 3 found something wrong with them and they had no idea. One, Dr. Cooper got on the phone, called a surgeon in Seattle, where they were from. This man had triple bypass surgery within 2 weeks. Basically saved his life. Dr. Cooper says early detection is the first step toward correction. And so I encourage you to think about the physical and look at that. Business, vocation, avocation, retirement. You see, one of the challenges, and as I talk to people, I said, I don't care if you're 8 years old or 108. The things we're talking about here apply to all of us. And I think at any point in our life, and we'll have different scores along the way. And when I work with people, I want them to not only, in fact, one of the slides today said normal work time was, I think, from 15 to 64. Remember that? I think you need to plan to 100. People ask me today, why do you do this? At your age, you're an old man. I tell my wife, I'm not old. She says, look in the mirror. You're old. But let me tell you, if from our time to today, if I have one person that does something to make a positive difference in their life, it was worth coming. And when I have people take the test, I don't want you to become overwhelmed. I'm going to tell you at the end, I'd like for you to take 2 of the 10 that you would like to work on and write down something that you would do. You see, I think it's as important to plan for your total life. I had an 82-year-old lady. I spoke at a church a while back. She came up to me and she said, you know what I learned? I'm 82, but there are some things I could do to help people. There's a difference I can make in people's lives. And when she makes a difference in somebody's life, do you think it makes a difference in her life? I think it does. Financial fitness. I said, Rhodes, you're talking to the choir. We work with Soltis. We heard Hal say today and talk about all the things they've done since the company was founded, and went over all of the ways in which they help everybody in this room. But let me tell you, the reason they've given me this opportunity, do you know what this company is about? It's about a lot more than money. They're interested in your life. They want you to enjoy life. They want you to accomplish in life. That's the type of people that you want to work with. I have one thing, though, that I want you to write on the card under this area. Write these words, please. Memory, money, investing. Memory, money, investing. People are going to say, what is memory, money, investing? Let me tell you what it is. 12 years ago, Gloria and I took our oldest two granddaughters to New York. Never been to New York. Flew into LaGuardia, got a stretch limo, took us to Times Square, checked into the Marriott, went to the 9/11 Memorial, went to a Broadway play, went to Central Park, rode the carousel, went to Serendipity's and ate ice cream, went to Tiffany's, all 4 floors, bought something in a blue box. You ladies smiling, I know you know about the blue box. And men, I tried to buy just a box, they won't do that. Bought something for each granddaughter, bought something for our daughter-in-law, and bought something for Gloria. Gloria's on a cancer journey. We couldn't go to New York now. Do you think I'd rather have the money in the bank or the memory of taking those 2 little girls to New York? And see, I think that all of us need to do that. I had an advisor came back and said, Dr. Rhodes, after listening to you, I went back, met with one of my best clients, and this lady, her husband died about 6 months ago. And she said, you know, I would really like for the total family to go on a cruise. We've never been on a cruise. And some can afford it, some can't. And he said, why don't you pay for all of it? She said, could I do that? He said, yes, that's memory, money, investing. There's something about adding the word investing that makes it legitimate. She said, I'll pay for all of it. I said, would you call my daughter and tell her? He said, sure. Said, I called the daughter and I said, you know, I know that you and your mom, have been talking about going on a cruise, and I know some could afford it, some couldn't, some could go, some couldn't, but everybody's going because mom's going to pay for everything. Said she didn't say anything for probably 8 seconds. And then she said, have you talked to mom? He said, yes, I've talked to mom. Said that lady came back to me and said, that's the best money I've ever spent. Let me tell you, you can't go back and get that time. You can't go back and get time with your children. And it may be $300. It may be $3,000. I've had people who they came back and said, you know, I was thinking about going to see my sister in Atlanta, Georgia. And it's a long way from this town, but I'm going to go. That's memory money investing. I had a financial professional came to me and said, you know, my wife and son and I have wanted to go to New York to a certain museum. We've talked about it. We're going to go. And I want you to think about your memory money investing and what you would like to do to create that memory. And the thing's so great, it's like I said earlier, you're working with a company that's interested in your life, not just your money. Knowing and focusing on your strengths. You know what we've been taught most in this country? To work on our weaknesses. And we grow up to be adults with some very strong weaknesses. When I do the coaching, I get people to go take the Strength Finder test. It's a book written by Tom Rath, R-A-T-H. And it identifies 30 minutes to take. Identifies the 5 major strengths of you as an individual. Do you know when you're working in your area of strength, you are happier, you do a better job, you enjoy your work? Some people have defined retirement as when you stop doing what you have to do and start doing what you want to do. And let me say this. I was looking at a magazine. Here's Parenting Magazine, Parents. It says, play to your child's strengths. It says they focus on what your kids are doing right. It's amazing. Children's strengths increase their likelihood of being healthy, happy, and engaged in school. Years later, the benefits include a lower risk of depression, better work performance, and even a happier marriage. And it starts talking about children that are 3 and 4 and 5 years old. And if you have a son, a daughter, a grandson, a granddaughter, and they're about to go to college, or they may be in college, encourage them to take that test. Some colleges are actually requiring it. Because if they identify what they are best at and what their strengths are, and if you have someone that's applying for a job and get them to include the results of this test in with their resume, it's phenomenal. I had an individual call me and said, my son's out of work, just graduated. I said, did you have him do the strength finder test to put it with his resume? He said, no, I didn't. I'll go do that. Called me 2 weeks later and he said he got a job. In fact, he got a job in Atlanta. But he said, he hadn't been there very long before they said, primary reason we hired you? Of all the applications we had, you were the only one that sent us information on your strengths and told us that your strengths would help our company become more profitable. So there are many ways to use that. Spiritual life, is that important? Is it personal? I think Myra Welch has summed it up very well in her poem, The Old Violin. The old violin was battered and scarred, and the auctioneer thought it scarcely worth his while to waste much time on the old violin, but he held it up with a smile. $1, $2, who'll make it 2? Going for 2? But no. From the room far back, a gray-haired man came forward and picked up the bow, then playing a melody pure and sweet, as pure as an angel sings. He held up the bow, 1,000, 1,000, 2,000, going for 3, going and going, said he. Some of them cheered, but some of them cried. What changed his worth? Swift came the reply. 'Twas the touch of the master's hand. There's many a man with life out of tune and battered and scarred with sin is auctioned cheap to the thoughtless crowd, much like the old violin. But the master comes and the foolish crowd never can quite understand the worth of a soul and the change that's wrought by the touch of the master's hand. Who's your master? Is spiritual important? I think it is. Spouse? Significant other? 56 years of marriage, and my wife tells me I've had you twice as long as your mother and you still have problems. And by the way, if you think I can score higher on each one of these areas, I'll give you Gloria's cell phone number. You ever taken a course in listening? You don't have to raise your hand. When's the last time you wrote a love letter? I did this in San Antonio, Texas, and someone in the audience said, to my wife? I walked out there, I looked at him, I looked at her, and I said, you do not have to go home with him. No. Writing a love letter? Do I do that for Gloria? Wrote her one last week. I was in Chicago all week and I wrote her a love letter. As I say, she is on a cancer journey. She is confined pretty much to bed, but she does more from that bed. She does more for the grandchildren. You can buy pretty much anything online you want. I go to the post office in Coma, Georgia, and I just walk in and ask, do I have any bargains? They said, you got 4 packages. She's buying for the grandchildren. She can get it sent to the house. But do I try to tell her I love her? Did I talk to her last night after our dinner? Do I have to work at being the husband today that I should be? I do. Is being a husband or a wife, does it work? Does it take dedication? Does it take commitment? How would you score yourself? Role of the parent, extended family, friends. Is parenting today challenging? It is. Is grandparenting challenging? It is. When have you written a letter to one of the grandchildren? And when I write a letter to the grandchildren, if I will write one to a grandchild, I end up writing everybody in her family. Our son, we have 2 sons. And I've learned not to depend on the U.S. mail. When one son calls the other and said, did you get that letter? Wasn't that nice? And the other son says, what letter? It's not good. So now I've put them all in the same envelope and FedEx it to where they get them all at the same time. And it's a way. Is it hard to say I love you? I have a new presentation I do on the power of words. Words that someone said, words that I've said, and words that should be said. I had a gentleman one day, it was a program we were doing, meeting in Orlando, and he raised his hand. He said, Dr. Rhodes, I'm 53. My dad is 75, and he's never told me he loves me. I said, that doesn't mean you can't tell him. His dad may have never told him. He said, well, I'll tell you what I'm going to do. Before I go back to North Carolina, I'm going to go rent a car. They're vacationing here in Florida, and I'm going to go drive to their condominium, and I'm going to tell my dad I love him. I called him the next week, and I said, Carl, how'd it go? He said, I prayed all the way down there. And so when I got down there and Dad was in the easy chair, and he got up out of the easy chair and came across, stuck out his hand, I went right through it and hugged him and said, Dad, I love you. He said, I love you too, son. He said, that's our standard greeting. Sure enough, I was having dinner with him in North Carolina. Before his dad got in the car, he hugged him. And I heard him say, I love you. That was a little over 10 years ago. And I said, Carl, wasn't it better to tell him now than wait until you are lowering him into the ground and then say, Dad, I love you? And he called and left me a message on the cell phone. He said, Dr. Rhodes, my dad died last night, and I thought you'd want to know. And he choked up and hung up. But you know what he realized? He told his dad, now I love you. There may be somebody in our life that we need to tell. I had a lady, and I was speaking in Nashville, Tennessee. She came up to me after it. She said, I have 2 brothers. I have never told them I love them. I am leaving this meeting to go tell my brothers I love them. Saying I love you is important. Lifelong learning, reading, learning, and growing in knowledge and wisdom. Is it exciting to learn? You know, Defeating Dementia. This is a great book. I can't remember who gave it to me. But it's a good book. Is dementia challenging? Can dementia be defeated? Can we learn about life? Can we learn about these investments? And I just encourage you to continue to learn. I read a lot, different books, but I also read a lot with my ears. And I pull it up on the phone. I see you have a Cracker Barrel restaurant. Now Cracker Barrel, for years, you go into Cracker Barrel, for $3.49, you could get any of their tapes on CD, any of the books. And then you could check it out and turn it into any Cracker Barrel anywhere. And I never missed an opportunity to be driving from Atlanta or our farm to Charlotte or Raleigh or Birmingham, somewhere I would drive. And I'd go pick out a book and listen. Learning, my wife, she said recently, she said, you know, if I didn't have cancer, I'd have never been able to learn some of the things I've learned because I've been bedridden. I said, it's not a bad way to look at cancer. And then generosity and gratitude. Do we have a lot to be thankful for? Is it great living in this country? I've been so pleased here. I was telling Hal this morning, in this city, if you just look at the number of American flags and the places you see that. And he was talking about time that he spent over the last 4 or 5 years. And that's where he and Jim are close together. But it's a situation to where we are blessed to live in this country. And when I was in Vietnam, had 188 men. When we'd put 118 out in that jungle, the first time one of those individuals was shot at and wasn't killed, he turned to me and he said, Dr. Rhodes, he was trying to kill me. I said, no, he will kill you. The freedoms we have in this country, the way we are blessed in this country, does not need to be overlooked. So let me ask you, what's the right score? It's the score you want. Is your life in balance? I have good news. Life's not over. There's not a person in this room that can't think about some of the things we talked about. Whether it's saying, I love you, whether it's taking the strengths test, whether it's writing a love letter. And as you fill out that green sheet, before you get up from that table, I'd like for you to do one other thing. When Clark and Kim and all put the program together, I want you to read one more time. Conference theme is awakening and ascending to new heights. Awakening and ascending to new heights. Awakening means take action. And I just encourage you to do that, to take action, to have the life you want, to not only work hard. And I think so many of us, and at my age, whatever years the Lord gives me, I think many in this room can make the greatest contribution the last 15, 20, 30 years of your life. Because you've been preparing all your life to do some things today that only you can do because of what you have learned and what you have prepared. So I appreciate again being here. I appreciate the support you're giving CNL. And I hope that you will work on the life score and have the life score you want. Thank you very much.
Thank you, Dr. Rhodes. What a great way to end the conference. I learned a lot. I've written down I need to go write some letters. just some great wisdom and great thoughts for us to think about. In learning from Dr. Rhodes, I hope that as you've come here today, that there's some things you've written down that you can ask your advisor, that's working with you. We hope to have taken you a little higher in your knowledge and understanding of what we're doing behind the scenes in your portfolio, the opportunities that are out there for you in your portfolios. And we just want to express our gratitude and our thanks to all of you for being here. We really do think we have the best clients in the world, and we hope to be able to continue to service you and help you to pursue your most important endeavors. Before I end the conference, Tyler Wilkinson just showed up. And Tyler is one of our managing partners that's been with the firm from the very beginning. And we're grateful to have him here today and love him and grateful he could come and be with you here at the very end of the conference. Thank you. This is the 14th annual. We're going to have a 15th annual for sure. And we appreciate you being here and hope you have a wonderful, wonderful weekend. Thanks.